this fall. Now, of course, that one big beautiful bill, people will be getting refunds on average, $4,000, about $1,000 extra in terms of a refund, relative to last year. So I think the hope is that there will be more optimism and that folks will have a different perception of affordability, and so maybe he won't need to lean into some of those policies. I think that was maybe last night was maybe a tell of that thinking.
Libby, he did focus on the stock market, certainly something we focus on here at Bloomberg, but talking about how good that was, right, and wealth created and good for our investors. But is that always a good read, or is that even a good read on kind of the state of the U.S. as a nation and as an economy?
Well, I think there are lots of examples where, voters have, one view of things, and the stock market is doing something different. I think if you talk to President Biden, I think that was one of his frustrations, and his economics advisor's frustrations is that actually the market was doing quite well, and the economy objectively was doing pretty well, but voters just didn't feel it. So perception is reality here, and going into these midterm elections, again, I think there is a hope that voters will feel better about things. And I think, to President Trump's credit in terms of the Trump accounts that were codified into one big beautiful bill, this idea of broadening that out and giving folks access to retirement accounts who may not have access to traditional 401k plans. So I think he is trying to tie the stock market performance to kind of everyday people's lives. However, we'll see. There's a lot of distance between here and there in terms of getting that actually effectuated into policy.
I think a lot of folks think, what a great idea, right? To get, if we talk about wealth creation, this is a great way to do it. But I do also think about, how do we pay for all this stuff? And when do we think about kind of the fiscal house and when that's going to matter? I know, go back a decade or so, and it was in every conversation I talked about here at Bloomberg, or even longer than that. Then it went away, and now it's back again. So I just think about, when do we have to when does that all come home to roost, or is it already?
Yes, I think if you contrast this speech with the speech last February, where President Trump was really leaning into this idea of DOGE and cutting federal spending and talking about the deficit, there was no mention of the deficit last night. And in fact, he talked about how important Social Security and Medicare were and how those would not be touched. As you all know, those are important programs. Bipartisan, wide bipartisan support. However, they're both very expensive as well. Our view here is that while there is no kind of immediate fiscal reckoning, I mean, the bond market, as you all know, hasn't necessarily, the bond vigilantes haven't necessarily come out here and disciplined Washington, but it's probably a question of, when, not if, that there will be an inflection point where members of Congress will have to actually do something in terms of sort of the fiscal trajectory. It doesn't look like it's close. There's not a lot of political appetite to increase taxes or reduce spending. But, our view is this sort of 6 to 7% deficits as a percentage of GDP. There will be a limit to that. And whether it's the bond market that is imposing that discipline, or when it's, Social Security Trust Fund starting to kind of go bankrupt, so to speak, which is expected to happen in the early 2030s. So we do think this is again, a question of when, not if, but it's just the when is probably not, under President Trump's term, at least as, if what the market signals are saying now.
Libby, you've seen different market cycles, different economies under different presidents. We've talked about this a little bit earlier with our own Mike McKee. How do you describe the Trump economy? Is it a good one?
Well, I think that, and again, there is a limitation to how much a president can actually impact the economy. So this is, for better or for worse, presidents, President Trump included, they like to take sort of credit for when things are going well, but also to sort of avoid any of that, blame when they're not. I think we would characterize this economy, this sort of K-shaped two-speed economy is quite real. Where if you just look at the components of GDP, obviously, AI-related capex fueled a lot of growth last year, as did the high-end consumer. I think there is a hope in 2026, and again, this is what I think Republicans are banking on, that the breadth of that economic growth is broader, and that this sort of the consumer at the kind of middle to lower end starts feeling better about things and starts participating in the economy. But if the economy just is predicated on kind of AI-related capex and the high-end consumer, that makes for a relatively fragile economy. And if you sort of see any kind of wobbles in the labor market, for instance, that could have maybe a non-linear impact. So I think it's a stronger economy. It's been a resilient economy for sure.
Right.
But again, I think Republicans are hoping that you can sort of broaden out the source of that growth and that they'll actually be rewarded then, come November.
But that AI spend, the impact on the market, sending it higher, and then, the wealth created among affluent spenders, that is something that Greg Dacco has certainly talked about a lot for us from EY Parthenon, and the importance. And if that starts to come undone, that could be problematic, Tim.
Hey, Libya, I want to shift gears a little bit and talk geopolitics, because ahead of the speech, the president, and he's gotten quite a bit of criticism in recent months, even from within his own party, about focusing too much on geopolitics. And while he didn't talk too much about geopolitics, what he did frame last night was, Venezuela and the ouster of Maduro, that being a win for oil companies and Americans who are getting oil and will get oil from Venezuela. And just now we are learning that Cuba has shot 4 dead in a clash with a Florida speedboat. That's just breaking news just in the last few minutes. I'm wondering about geopolitics, though, and the political risk for a president who came in and said, no more on a platform, no more foreign wars, wants to end wars, for focusing so much on geopolitics within his first year in office. Is that alienating some of his base?
I think it's confused some of his base for sure. As you said, that there is a wing of the sort of Trump base that is more isolationist. I think those folks thought that President Trump would be sharing in that view. He obviously talked about ending the war in Ukraine. That has not happened. He's talked about bringing kind of peace globally. I think you could sort of quibble about whether that has actually been true or not. And then to your point, he has focused on some of these more specific operations. Now I think Venezuela, the way that they would characterize, the White House would characterize this is an extradition, kind of a high-profile arrest, if you will, that required a lot of resources of the U.S. government, but was quite different from regime change. We'll see kind of how that plays out. But I do think, Tim, you're right to sort of focus on this politically, because midterms are all about turnout. It's not about persuasion, right? You need to get your base turned out. You need them to get excited. Whereas a general election, it's about sort of persuading folks who might be kind of on the fence. Again, midterms all about kind of your base turnout. And if your base is at all, feeling maybe a little bit less enthusiastic about you, they may not turn out. And so I do think this, we'll sort of see how this kind of movie plays out. But you could see President Trump, maybe kind of be forced by his own party to be less focused on these issues, because they just doesn't have sort of the galvanizing effect as the kitchen table gas and grocery issues you typically have. The last thing I'll just say, though, is I think President Trump was quite clear about what his framework was he was using yesterday as it relates to Iran. He definitely did not close the door on potential intervention. He also didn't necessarily endorse that he was going to do this either. So he was using sort of this clear framework about about Iran's ability to develop a nuclear weapon and what have you as kind of a litmus test. So I think he's trying to be more clear about what it would require to engage. But again, politically, he may be forced to back off this as we get closer to the midterms.
Libby, going back to the affordability issues, we know President Trump and Vice President J.D. Vance are hitting the road tomorrow and I believe on Friday to kind of test their affordability message with voters in Texas and Wisconsin this week. So things like, obviously the tax cuts that are already part of his big, beautiful bill, these new savings accounts for kids, maybe banning of institutional investors from buying homes, although we didn't get anything more on that. Are there policies or clarifications of policies or implementation of policies that are likely to come leading up to the midterms that you think kind of improve the affordability issues for those who will be voting?
I think the reality is that even if President Trump wants to see some changes, it's going to be very difficult for Congress to get anything done before the summer, which is really the de facto end of this Congress. That's when they will adjourn for their sort of summer traditional summer recess for them to really go back to their districts and to campaign. So in terms of the runway to actually effectuate policy, we are talking about a very short one, to July basically, and we don't see Congress moving. We don't see them passing another tax bill, another spending bill, another bill that prevents institutional investors from buying single-family homes or what have you. There is a housing bill that they may be able to pass both chambers and get signed into law, but that is likely going to be it. So I think kind of for all intents and purposes here, Trump will have to lean on those policies he can effectuate unilaterally, which is the agencies buying, agency MBS. That is one thing that he did not talk about in his speech. It's kind of for us, bond nerds over here. but we do think that's actually, that and deregulation, those are two things that he can and will, we think, continue to lean on to help, improve, at least mortgage rates and sort of, the rate environment in general, and hope that will actually trickle down to some kind of the perception again of affordability among voters. But outside of that, we do not expect Congress to move, really, period, between now and the midterms.
All right.
I don't recall seeing mentions of agency MBSs on the prediction markets.
Wait, that's when they all stood up. Remember?
Okay.
They like the...
Exactly. The only bipartisan moment we saw was at our agency MBS.
Bringing the parties together. Libby Cantrell, you rock. Managing Director, Head of Public Policy over at PIMCO, joining us right here in New York City. Don't forget to catch our weekend show, Bloomberg This Weekend. David Gora, Christina Ruffini, Lisa Mateo bring you unique conversations on politics, policy, and so much more, lifestyle, culture. Watch and listen on Bloomberg TV, Bloomberg Radio, and the Bloomberg Business app. Catch it Saturdays and Sundays starting at 7 a.m. Eastern. Yeah, it's nothing like mortgage bonds or bring the
someone who gets excited about mortgage bonds is Charlie Pellet. He's standing by at the Bloomberg Business Week studio.
Of course
He's also
he does.
watching markets. Hey, Charlie.
Without a doubt. Absolutely watching markets in video after the bell. Got to begin, though, with fast-moving developments. Here's the latest on the situation with Cuba. We brought you headlines moments ago, but Cuba's government says its forces have killed 4 people and wounded 6 others who were traveling in a speedboat with Florida tags and opened fire on the island's border patrol. Now, the Cuban Ministry of the Interior says that vessel did approach within 1 nautical mile off the coast of Villa Clara. U.S. and Cuban tensions are running high as President Trump's administration has effectively imposed a naval blockade on the communist-run island and dramatically reduced its access to fuel. Again, developing story. We will have more details as they become available right here on Bloomberg Business Week. The other story we're keeping an eye on, CME has now restarted natural gas futures after a glitch halted trading. That halt lasted about 35 minutes, also affected trading in metals on CME's Globex platform. Stocks are pushing higher. In fact, we are just about the best level of the day right now on the S&P. All of this ahead of NVIDIA. S&P right now up 0.8%. The Dow up 0.6. The NASDAQ Composite Index up 1.3%. The NASDAQ 100 Index up 1.4%. The VIX is at 18. 10-year yield 4.04%. Gold is surging 1.1%. 52.02 the ounce. West Texas Intermediate crude little change. 65.63 a barrel. Unchanged right now. Bitcoin, though, major story. It is up 7.5%. Bitcoin at 68,882. Again, NVIDIA after the bell. NVIDIA shares up 2.2%. Also reporting after the bell, Salesforce up by 3.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Shares of Mercado Libre having their biggest intraday drop since 2024, down about 14% intraday after fourth quarter net income missed analyst estimates as the company continued to invest heavily in its main business lines. Now, I should point out analysts are broadly positive on the growth trends at the company. They did note that elevated spending will pressure the company's margins. Meantime, our own in-house Bloomberg Intelligence analyst, Poonam Goyal, she follows the company. She pointed out that AI is a catalyst, helping spur ad sales and acquire business, and singled out Mercado Pago, I hope I'm saying it correctly, Pago AI assistant. So let's get into it all and look at the quarter in the business. It's so great to have back with us Martin de los Santos. He's CFO of the e-commerce firm Mercado Libre, and he joins us from Montevideo, Uruguay. And it is great to have you back. How are you? And talk to us a little bit about business.
Thank you, Carol. Thank you for having me. It's a pleasure seeing you again. As we mentioned yesterday on earnings report, we are very excited about the growth that we are delivering in all of our businesses. You mentioned advertising that has been helped by AI, growing at 70% year on year. Our e-commerce business, in particular in Brazil and Mexico, growing 35% year on year and growing market share. The same thing with Mercado Pago, our fintech platform, which is also growing very rapidly in a region where financial inclusion is very, very low. So the opportunities ahead are tremendous, and the results that we deliver in Q4 and in 2025 makes us very, very excited, despite the fact that we are conscious that we're making investments that put some margin pressure in the short term.
Well, you have a great view of the consumer, given where you sell and what you sell. If you were to characterize consumers differently in different parts of the market, different parts of the world that you sell in, how would you characterize the consumer?
I think if you compare the consumer behavior in Latin America relative to more developed countries, I think we're behind in terms of adoption of e-commerce, and this represents an opportunity to us. Penetration of e-commerce is only 15% in Latin America. It's half the penetration than the US. Also, there are some barriers to that. Payments, logistics is more complicated. So we have built our own logistic infrastructure. We build our own payment methods. So we have built a platform that is enabling people to move online. So I think those are the main differences. At the end of the day, we sell everything in Mercado Libre. And what we're doing is we're trying to move people online and create a market.
So your sales did beat fourth quarter expectations. We were just talking about some of the numbers with you. 45% year-on-year increase in net revenue, $8.8 billion, driven by customers taking advantage of free shipping perks and credit offerings. I am curious about these momentum drivers, whether they continue, and I'm really interested about the credit offerings. Does it show, Martin, strength of the consumer, or a consumer who needs to be buying more on credit?
Yeah, let me first talk about the growth opportunity that you mentioned. We delivered 45% year-on-year growth. This is the 28th consecutive quarter in which we deliver more than 30% year-on-year growth in terms of revenue. So growth has been consistent, and when we look ahead of us, because of the large opportunity that we see in Latin America, it will continue to be there. And this is the reason why we are investing behind growth. And in terms of credits, Latin America is a market where it's very much underdeveloped in terms of penetration of credit. If you look at Mexico, for example, fewer than 15% of people have a credit card. So what we're doing is we're bringing products to them that will include them in the financial system, and they also help our ecosystem, because when people pick up the credit card for the first time, they tend to buy more on Mercado Libre. So it is very synergistic. But at the end of the day, what we're doing financial inclusion, and we have the objective of becoming the largest digital bank in Latin America, and we're working towards that.
Martin, you mentioned when we were just a few moments ago the penetration in Latin America of e-commerce and how it's half of what it is here in the United States. So there's a lot of opportunity. There's a lot of runway for your company. What's a good way to think about the progression over the next few years? Like, how does that increase in 1 year, 3 year, 5 years from now? What's a good goal for investors to have an understanding of?
I think a couple of ways of looking at it. I think the penetration of e-commerce, there's no reason why it shouldn't reach the levels of China, north of 30%. So that's double the penetration that we have today. Also, if you look at the number of buyers, we have 120 million buyers in our platform in a region of 600 million. Of course, we're growing at 26% year on year, the number of users. But as we continue investing and improving the user experience, that should continue to deliver growth. So we see plenty of runway for growth ahead of us in commerce, and the same thing could be said about fintech.
But when? Like, if you were to give a timeline for when that would happen, when would different Latin American markets reach what China has experienced?
I think it's a matter of, it's hard to put a timeline. I mean, we've seen a lot of acceleration since pandemic in terms of penetration of e-commerce.
Yeah.
And if we continue the trend, I think we should be able to get to the levels of where China or the US are today, maybe 5 to 7 years.
Okay.
But then we should continue to increase that penetration as well going forward.
Hey, one of the things I want to go back to, and I think you touched on this, but it's part of why we're seeing a negative stock reaction, and that is the substantial investments that you guys are making in e-commerce and the fintech unit. Analysts say that it's necessary. You got to make these investments in order to bring about future growth. So on that, because investors are questioning it, certainly in the trade today, Martin, how should we think about the run rate here?
Yeah, let me give you an example to make it more tangible what we're doing, right? We lowered our free shipping threshold in Brazil, and that was not the first time that we did it. We did it several times since 2017. And that's a way to enable more people to come online. Shipping cost is one of the main frictions for people to come online. So when we did that, we did put pressure on margins in the short term, and we're conscious of that. But we have also seen very important metrics in terms of growth. Increased number of users. We accelerated items sold from 26% year on year to 46%. We see more users coming to the platform with more engagement. They tend to buy more things on Mercado Libre. So all the metrics are pointing in the right direction, and this is the way to go. In particular, if you consider the relatively early stages of development of e-commerce in Latin America. So we think, again, when we try to optimize long-term margins as opposed to short-term margins, and we're very confident that the investments that we're doing in commerce in this case will help us to achieve that goal.
But will it be a drag on margins for a couple more quarters? Like, do you have a good feel on how long that continues to be maybe an issue? Because obviously investors see it as an issue today.
Yeah, of course. I have been consistent to the market saying that our main objective is to capture the large opportunity ahead of us, and we will not hesitate to invest to capture that opportunity. We have a long track record of investment with cautious and very prudently, and we are expecting returns on those investments, but in the long term. So if we see more opportunities to invest in 1P, cross-border trade, expanding the free shipping offering, the credit card, we will continue to do so because we think it's the right way to go in terms of expanding and maintaining a leadership position in both commerce and fintech.
Well, on that, marketing expenses, they rise when you're trying to increase demand. If you think about churn or like if you reach a new customer, the cost of acquisition of that customer, how long does that customer stick around after using the service? And how do you make sure that you don't have to keep spending to entice them to come in?
That's a great question. This particular quarter, last year actually, we increased the level of investment in advertising, and the cohorts that we incorporated in 2025 perform a lot better than the previous cohorts because they come and they find an ecosystem that works better, that has more free shipping, better financing alternatives, better assortments. So all the metrics that we measure in terms of retention and engagement of users that come through our advertising investments are improving year on year, and that gives us confidence to increase investments like we did in this particular year.
I don't know if this is a crazy question, but I want to ask you before we wrap up.
You talked about this earlier on the call today.
Well, what's been going on in Mexico, and the taking out of the cartel chief, and what I guess we kind of continue to watch this
disruptions at airports.
Exactly. Is any of that? Are you seeing that show up in any way in terms of consumers from Mexico?
Well, obviously, we are monitoring the situation very closely to make sure that our employees and our customers and partners are safe, given the recent events. We have not seen any disturbance on events, but we're monitoring the situation and close contact with authorities to make sure that we don't get any disruption.
All right. We're going to leave it on that note. So appreciate that you addressed that as well. Martin, thank you so much. Really appreciate the time today. Martin de los Santos, he is the Chief Financial Officer of the e-commerce firm and Latin America's most valuable company by market cap. We've seen certainly that trade play out, Mercado Libre. And we should point out the ticker and the stock down about 14% year to date. It gained about 18% last year.
Hey, I do want to bring an update to a story that we've been following all hour. Cuban forces killed 4 people and wounded 6 others who were traveling in a speedboat with Florida tags after they opened fire on the island's border patrol. The occupants of the vessel opened fire on security forces, injuring the commander of the military vessel when approached to identify the passengers. Now, the Interior Ministry said Cuba reaffirms its commitment to protecting its territorial waters based on the principle that national defense is a fundamental pillar of the Cuban state.
We should remind everybody that U.S. and Cuban tensions definitely running high as President Trump's administration effectively has imposed a naval blockade on the communist-run island and dramatically reduced its access to fuel that came off of the actions in Venezuela. Now, the president has also mused about the collapse of this 6-decade-old regime. The U.S. State Department did not immediately respond to a request for comment, so we are awaiting some kind of comment, perhaps, from the U.S. government.
Well, let's take a look at how markets are looking. We're still seeing some buying. The S&P 500 up 0.9%. The NASDAQ Composite up 1.3%. The Dow up 0.6%. NVIDIA is what I'm watching, up more than 2.3%. That company reporting earnings today. After the close, 75% gross margin is the expectation, Carol. And 420 is when we expect those numbers to cross.
Yeah, we'll be watching. Expectations are high, and we know this is a stock that really hasn't been doing much this year. I'm Carol Messer, along with Tim Stanovic. Let's get to some stocks on the move on this NVIDIA Wednesday, I'm going to call it. Bloomberg News Equities team leader and deputy team leader for U.S. Equities, Carmen Reinecke. She is in the house, and she joins us with some stocks on the move. Let's start with this one. It's definitely on my gainer list. Axon.
Yeah, so right now this is the top gainer in the S&P 500, ticker AXON. So shares are up about 20% right now. So this is the maker of Taser, right? And it also does public safety software. So shares are up after earnings. They reported earnings that were better than Wall Street's expectations, and analysts really cheered it because they see this company as an AI winner. So they're using AI sort of across their software platforms, and so this is such a benefit.
Tim is looking at me like,
well, because
we talked to these guys.
Yeah, we have, and they're very they're so bullish on this.
Yeah.
And the company also, you know, with the body cameras and the footage that they get from the
robotics
body
is something I
cameras.
think they're exploring a lot of different things.
Sorry, but we digress.
Yeah, so I mean, they're just seen as one that could be a winner as opposed to disrupted, as we've seen, you know, with software stocks really get hit there. So that's Axon. Another place that I'm looking today is the housing sector.
This is an interesting story.
Yeah, I've been looking at the housing index, S15 Home. So it's down about 4% today, the worst since October. So there are kind of a few things going on here. First of all, Lowe's, so ticker LOW, shares are down. The company forecast full year sales that were short of expectations and sort of signaled that there's still weakness and, you know, uncertainty in the housing market. And then secondarily, so investors are really hoping that Trump would address this more in the State of the Union speech last night, and he did a little bit, but I guess not as much as investors were really hoping, so sending shares of those home building stocks down today.
No more specificity, right, in terms of a policy that might address the housing affordability issue. Let's go to Netflix. What's going on there?
Yeah, so Netflix NFLX is up 6% today. This is the best day since April 22nd, Earth Day. So basically what happened this morning, so Warner Brothers Discovery said they have a new offer for Paramount Skydance, and that could lead to a better deal than the existing agreement that they have with Netflix. So investors seem to be excited about this because it would mean, you know, Netflix is no longer in this deal, and they could walk away with a breakup fee of $2.8 billion. So we're seeing shares having, you know, some resurgence after it's had a really, you know, pronounced sell-off from, I'm looking, June of last year.
Well, that's what's so remarkable about this is that investors have been pretty bearish on the idea of this company taking on these other assets. So I don't know, it's interesting to see a stock move like this today higher, given that it's coming from a place where investors have sent the signal, this is a lot of money to spend, and we're not entirely convinced it's the right way to spend the money.
Yeah.
I don't know.
I'm thinking of...
what are you thinking of?
Who did we talk to yesterday from MoffettNathanson, and specifically, Rob Fishman. And basically, like, if Netflix doesn't get it, it's kind of okay. Like, they can walk away, and I think they're going to be buyers. Just looking for the commentary that he had. He said, with Netflix's stock at current depressed levels, investors should win either way. We see longer-term benefits of owning Warner Brothers assets not properly reflected at these levels. But if Netflix walked away from the deal, the company's core fundamental drivers of subscriber and ad growth, plus pricing power, should rebuild investor confidence that Warner Brothers was truly nice to have and not a must-have.
Exactly. You're not going to quit. I
thought that was smart.
I think that makes sense. You're not going to quit Netflix because it doesn't have The Sopranos.
Right. You'll be okay, right? You'll still be watching.
Winning by walking away.
Exactly.
I think we can all learn something from that.
It's okay. Sometimes, right? It's a decision, and it's better than not.
The deal's not done. We don't know how this deal will end. He did say, he's like, I have no idea who's going to win this.
No, right. Exactly.
Okay, sorry. It's also NVIDIA Day. You're watching shares of NVIDIA.
Yes, exactly. So we've got to talk about NVIDIA. Shares are up 2.2% right now. And this is a little notable heading into earnings because the stock has not seen a lot of momentum in the past really few months.
Yeah.
So investors sort of rotating away from those big tech stocks into maybe like less risky parts of the market. But today we're seeing green on the screen heading into these earnings. A lot of things investors will be watching for, mostly the guidance. You know, if Jensen can sort of reinvigorate, you know, investor enthusiasm around AI. And sort of under the hood, I'll be looking at gross margins.
Right.
If they say anything about China.
Right.
And then, of course, that guidance, you know, what they're seeing, especially after we saw so much spending from the hyperscalers sort of forecast into the future.
What did Ian say? Something like operationally, though, or only Ian King who follows it, it's hard to kind of argue with what is going on at this company.
I mean, they've said what surprises are going to be left for us is basically what Ian said, because we've heard a lot from Jensen about demand. He said it's off the charts. Shares down about 4.8% from all-time highs.
Be sure to check out Stock Movers. Find it on Apple, Spotify, or anywhere you get your podcast. Carmen Reinecke, thank you so much. The close coming your way on TV. Tim and I continuing on radio.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
NVIDIA earnings will be strong, but will they be strong enough? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic, kicking you off to the closing bell here in the U.S. and counting you down to the latest earnings report from the market's most consequential company. We take a look at the board here at 3 p.m. New York time. A little bit more of a risk-on vibe, though we should point out that is sort of a function of the risk-off vibe that we had seen in the past 2 or 3 weeks. The market getting its mojo back with the NASDAQ leading the charge up about 1.4% on the day. Chip stocks up at the top of that board, and a little bit of a rebound that we're seeing on this day in some of those beaten down software stocks. Even Bitcoin getting in on the action, though still pinned below that $70,000 level. And a market right now pinning its hopes on what we learn a little bit later this afternoon from NVIDIA. Now, we should get this out of the way right now. Make no mistake, NVIDIA's numbers, they're going to be good, very good. Bloomberg tracking shows Wall Street expects a 68% jump in quarterly revenue to $66 billion, a 72% jump in adjusted earnings, and adjusted gross margin that likely widened to 75% last quarter. And therein might actually lie the problem.
The difficulty NVIDIA has is it's gotten so big, and for it to keep momentum going, the deals that we're looking at, getting these data centers built to the scale that is going to be sufficient for their numbers, that's going to be challenging.
There is a balance between the optimism and skepticism, and it's hard to overstate NVIDIA's impact, not just because it has the biggest market cap in the world or the biggest weighting in the S&P, but because of how interconnected that business is to basically everyone else. Almost 20% of its revenue alone comes from Microsoft, the fourth largest company by market cap. 6% comes from Alphabet, 9% comes from Meta, and that says nothing of all the other circular investments made among NVIDIA, the hyperscalers, the AI companies, and everyone else in between. Now remember, this is a stock that over the past 3 years alone accounted for almost 1/5 of the S&P's gains. But since its record high in October, it's contributed nothing. In fact, it's actually held the index back, the 9th biggest drag on the S&P, as the once dogmatic beta trade in AI now turns fundamentally selective amid questions about just where this trillion-dollar AI boom is actually going, a rotation by some investors into names with heavy assets and low obsolescence. Sectors like utilities, basic resources, energy, and other areas deemed as insulated from the AI wave. You can see those two bottom lines on your screen. That top line, that's the NASDAQ, and that's materials and energy catching up with the NASDAQ 100 as we move closer to those earnings from NVIDIA. Mira Panda joins us right now here in Studio 2, Executive Director and Global Market Strategist at JP Morgan Asset Management. Mira, great to see you.
Thank you for having me.
I do want to talk about this rotation trade that we've seen over the last few weeks or so. This idea, not so much that people are selling off the market or even selling off AI, but the idea of looking for, I guess, companies, industries are maybe a little bit more insulated from either the upside that AI ends up being the disruptor or the downside that this is a bubble and it pops.
What we have to think about is the fundamentals around AI have not changed that much. You're still seeing explosive earnings growth. You're still seeing that actually valuations, while they're expensive, come down a little bit in recent weeks. The demand is not slowing, and the balance sheets are overall reasonably strong. So what we're seeing so far this year is more of a sentiment shift as opposed to a fundamental shift. We went from last year where is AI a bubble to this year, is AI so important and so powerful that it's going to displace entire industries? So we do have to consider that sentiment shift and the fact that now when you look at earnings of these Mag 7 companies, they are being punished for having that AI CapEx upside surprise if that is exceeding the revenue surprise. So investors are getting a little bit more scrutinizing about that overall spend. spend, and therefore thinking about, well, who's the beneficiary of that spend? Because if we don't know who the right innovators are, who the ultimate winners are, at least we know that whoever's in the game is going to be spending, and that's why you're seeing the players within industrials, materials, utilities continue to benefit from this trade, while maybe some of the tech players have benefited less so far this year.
I am curious, though, with about some of those tech players, at least the ones that got sold off, primarily the software companies, you're now looking at multiples that are, in some cases, below where they were pre-pandemic. So, I mean, you've had a real reversion here, and I'm wondering if that creates a buying opportunity, because even if you do believe some of these names will be disrupted, no one seems to be saying that's happening tomorrow. And maybe 2028, maybe beyond. But there's quite a bit of time in between now and then.
That's true. I mean, look, we do own stocks for the long term. So even if you think in 20 years a company isn't going to work out, maybe you don't necessarily want to own it today because you don't necessarily think things will get better before they get worse. But at the same time, I think the reality is, working at a large company, you do need some scale, some consistency across your software. And if you think about, again, a large company where you don't want you creating a different HR system, to me, to not being able to aggregate data properly, there is a real value to the logic and hierarchy that a lot of these different software companies create. So I don't think we should undervalue that. And we've already seen a huge re-rating in some of these names. So I think now it's thinking about what value they do bring to the table and how they leverage AI to become more powerful and stronger in their offering, as opposed to get wholesale displaced by it.
When it comes to NVIDIA specifically, this raises a question, too, about hyper-growth companies. The idea that that's not a sustainable rate, right? I know NVIDIA's on a revenue basis has been growing at a high double, and in some cases triple digits now for the last few years. We know that's not sustainable by any measure. How do you invest around that? Because no one's saying NVIDIA is going to go away. They're probably still going to be dominant. They may not be the monopolists that they've been in the high-end chip space. But is there any historical precedence to show maybe how investors sort of adjust to that?
I think ultimately we have to think about is the starting point of your portfolio, the starting point of that index, and the fact that we are heavily overweight a lot of these different companies. So irrespective of their trajectory, which broadly does seem very strong when you still see 20% plus growth rates in profits for the Mag 7, it still doesn't mean you need to own 40% of your portfolio in just 7 names. So I do think it's about tweaking around the margins and thinking about the broader beneficiary landscape around AI. I mean, if you look last year at the best 50 performing companies, only one of them was a Mag 7, but you still had 19 other companies that were from the technology sector and the communication services sector. So you have to think broadly beyond who else is entering the ecosystem and who could be potential winners. Plus, again, that infrastructure layer where you had another 20 or so companies coming from some of these other sectors that tend to be a little bit more value-oriented, but are plugging into this overall AI theme. So it's not about the biggest, because the biggest may not always be the best, but thinking about how those opportunities evolve. And I think it was so hard to invest in 23 and 24 when there was such a concentrated, invincible trade around some of these companies. It actually makes it easier today to have that eye towards quality, profitability, and differentiating among different companies, because the market started to differentiate much more.
I do want to ask you about another segment of the market. I know AI has kind of consumed us all, but we're still a consumer-led economy, and despite AI's contributions to GDP, the consumer is still leading the charge. Is that investable at this point? Meaning, do you think that some of the strength that we've seen in the consumer space is going to continue based on your model of how the economy goes?
We've been seeing a K-shaped economy that may collapse into a little bit more of a V over the first half of this year, because while upper-income consumers continue to spend, the top 20% has grown their net worth by $50 trillion this decade. They contribute about 40% of the overall spending. The lower-income and middle-income consumers could get $1,000 more in their tax refunds over the course of this season. And we know with the American consumer, a penny earned is a penny spent. And I think that's why you're seeing areas like staples pick up a little bit more this year and have double-digit returns year to date, because some of that lower middle-income consumer that has been challenged, and therefore challenging volumes and revenue within areas like staples, actually is showing some signs of life. And people are thinking about the simple luxuries, the beverages and the snacks and certain things along that complex, tobacco, that have been benefiting. So you look underneath the surface at staples, and there's a broader rally across a lot of the different subsectors. And I think that there's some room for discretionary to pick up on those lines as well, as the consumer perhaps heats up in the first half of the year. And there's some upside risk for the consumer in the second half of the year, because if you think about heading into midterm season, and if we see the economy start to slow, even back to trend, but perhaps below trend, you may get those tariff rebate checks or some other form of stimulus direct to consumer, juices up the economy a little bit more, and again, helps the bottom part of that K.
Yeah, that's a good point, too. You always kind of forget these election cycles tend to bring out the best, unfortunately, in our politicians from time to time. Mira, always love it. Mira Pandit, Executive Director and Global Market Strategist at JP Morgan Asset Management. As we count you down to the close and count you down to NVIDIA, we are going to continue our focus in the next block on the consumer. Kava having a phenomenal day after its fourth quarter results seem to suggest that, well, all of that talk about slot bowls, well, that might have been nonsense. Kava co-founder and CEO Brent Schulman, he's going to be joining us in just a second after the break. Plus, we're going to get a little bit deeper into what's been going on in the world of private credit, specifically when it comes to CLOs and leveraged loans. A conversation up ahead with a legend in that space, Glenn August, the founder and CEO over at Oak Hill Advisors. And then we turn back to NVIDIA, our coverage, counting down to the chip giant's earnings report, a deeper dive into those numbers with experts from all across the space. You don't want to miss it. This is The Close on Bloomberg.
Bloomberg.
Shares of Kava right now having their best day going back to at least 2023, not far off from when they had their initial public offering. This after the fast casual chain reported earnings last night, and more importantly, gave a forecast going forward here for comp sales growth in a range of roughly about 3 to 5%, coming in above Wall Street estimates, and quite frankly, defying a lot of expectations about some of the dour sentiment amongst fast casual names. Joining us right now is the co-founder and CEO of Kava, Brett Schulman. All right, Brett, we've seen a couple of your fast casual peers already report. They did not do as well as you did. What was specific to Kava that allowed you not only to post those numbers for the most recent quarter, but to guide as aggressively as you did?
Hey, Romain, great to be back with you. I think what's driving our strength is what we've seen over the 15-year history of Kava, and we just celebrated our 15th anniversary last month, is the growing and strengthening underlying demand for our differentiated Mediterranean cuisine, and then how we've worked every year to improve the relative value of that proposition and how we deliver that cuisine. So not just underpricing inflation by over 10% and underpricing the average restaurant brand by over half in recent years, but really delivering a holistic value of the quality of the ingredients we serve, the relevance of that cuisine, that Mediterranean cuisine where taste and health unites, the convenience in which you can access in a multi-channel format, and the experience you have when we deliver that hospitality in our physical spaces. So that's all come together. We noted it coming out of Q3. When you looked at our new restaurant opening class in 2025, they were hitting record levels. And then on a 2-year basis last year, we sequentially accelerated every quarter. So while the 1 year had some deceleration, and we were certainly dealing with a lot of the macroeconomic headwinds that many brands were dealing with, the underlying strength persisted and then firmed up and strengthened further as we exited the year and came into 2026.
I am curious about growth going forward. You're now over 400 restaurants, 439 or so, I believe, was the number that you gave on the call. You're approaching now a level where scale, I mean, obviously that's a benefit, but it also could pose new challenges in managing your business. And I am curious, as you continue to expand, how are you going to make sure that you manage the consistency and reliability at all of those locations?
Yeah, we've invested heavily over the years in our infrastructure, whether it's our vertically integrated manufacturing production for our dips and spreads, our technology platforms, our digital order platforms, or our physical environments in our kitchens. We rolled out new Turbo Chef ovens last year that simplifies cook production while not diminishing any quality, makes it easier for our team members to deliver on that. We rolled out our new kitchen display screen systems to all but 69 restaurants that we're currently retrofitting this year. That helps our teams not only with digital order production productivity, but improved order accuracy and timeliness. And then on the people front, we launched our Flavor Your Future platform at the end of the year to really broaden and deepen our pipeline of role-ready leaders to open those new restaurants with operational integrity, and brought on recently Doug Thompson as our new Chief Operations Officer. Doug has decades of experience really as a people developer and people leader in the industry to help build those future leaders. Because I always say the biggest governor to our growth is having qualified role-ready general managers to open those restaurants. And in the spirit of doing that, we rolled out a new assistant general manager position in December. 60% of those roles are now filled. We're on track to complete filling those roles in the next 6 months.
Yeah.
And what that does is it provides a deeper manager experience complement across all 14 day parts, 7 lunch, 7 dinner, as our average unit volumes have increased in recent years from 2.1 to 2.3 to now 3 million. Those are very busy restaurants. We want to make sure we have the right senior leadership to guide our teams every location, every shift, set us up to be able to have those new leaders to open new restaurants.
I am curious about the menu, the in-store menu, and whether you are planning any sort of meaningful changes or additions, I should say, or subtractions for that matter, in order to just kind of keep up with taste.
Yeah, Romain, we're always constantly evolving our menu, but within the lens of our Mediterranean brand essence. And so you saw in January, we brought back our fan favorite white sweet potatoes. We launched a new greens blend, our power greens blend, which has been incredibly well received. And our delicious sumac, sour cream, and onion pita chips, another flavor innovation on our pita chip flavor platform. And then I'm excited to say that before the end of the first quarter, we're going to be launching our first seafood protein item. We're going to have pomegranate glazed salmon hitting the menu by the end of the first quarter. Really a core aspect of the Mediterranean diet. Excited to bring that to our guests here soon.
Okay, I didn't realize you never had seafood protein. And I assume this is all still going to be in bowls. Some of your competitors have said bowls might be over.
Yeah, so we serve bowls, we serve pitas, and look, Romain, people don't wake up and say, I want to go to a fast casual, or I want a bowl. People wake up and say, I want delicious food that I'm craving. I want Mediterranean cuisine. I want flavorful, satisfying food. And more, they want food that they feel good about, that they don't have to make compromises to eat. And that's where Cava comes in.
All right. Well, Brett, congratulations here on the quarter. Obviously, still a lot of ways to go here with regards to getting things back on track, but investors really seem to like what they heard last night, and we'll catch up with you soon, I'm sure. Cava's co-founder and CEO Brett Schulman here on the heels of their earnings, a 25% jump right now in the stock, best day going back to 2023. When we come back, we refocus in on the tech sector and those earnings out of NVIDIA, a deeper dive of what to expect when we come back after the break. This is The Close on Bloomberg.
Short of power. AI is accelerating global electricity demand, and supply is struggling to keep up. From high-purity polysilicon in Malaysia to wafer in Vietnam to utility-scale renewable project in the United States, We are creating energy that keeps innovation moving. Because what we build today will power the world tomorrow.
Asia is at the forefront of some of the world's biggest stories. And we're here where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Time now for our top calls, the big movers on the back of analyst recommendations. Let's start off with Workday. Evercore ISI downgrading the finance and HR software company to inline and cutting the price target to 160 in the wake of its earnings. The analysts raising some concerns that the new CEO, coupled with a still early innings AI strategy, will make for a more difficult investment narrative. Nevertheless, those shares up for a second straight day. Next up, Oracle, Oppenheimer upgrading to outperform with a 185 price target. Despite negative sentiment in the software as a services space taking its toll, the analyst says Oracle is still a, quote, AI winner. Those shares up for a second straight day. And finally, let's take a look at HP Inc., HPQ. Morgan Stanley cutting their price target to a low of $16 and maintaining an underweight rating after the company's results yesterday. The analyst warning that the updated guidance isn't actually bearish enough and sees further downside risk from current levels. HPQ basically unchanged here on the day. And those are some of our top calls as we stay in the tech space and continue the drumbeat to those earnings in just about an hour's time out of NVIDIA, the world's most valuable company, the largest chip maker, and quite frankly, the only chip maker anyone seems to talk about. My next guest, for the first time in a couple of years, actually says NVIDIA may not represent, though, as much of a bellwether for the market. Gil Loria is D.A. Davidson's head of technology research, and he joins us now. All right, Gil, on one hand, I say that's a bold call. On another, I kind of get it. I mean, we've been talking about NVIDIA for the last 3 years in a way where it has consumed the markets, the economy, and everything in between. Not a bellwether anymore, though? Who is?
I think this quarter, actually, the most interesting result was Alphabet, was Google. They are now considered the leaders in AI. Their result was spectacular, and the market rewarded them and the rest of the market for it. While NVIDIA, which had been the bellwether for the last couple of years, mostly because it continued to exceed expectations at what appeared to be a miraculous rate and brought all the positive AI sentiment with them, I think now there's a much broader perspective of the different moving pieces in AI, not to mention the fact that we now know and understand that we know NVIDIA's results really well before they report them because their big customers report a month earlier, and they just told us they're going to spend a hell of a lot more on NVIDIA GPUs. So we know that that's what we're going to be talking about today. Incredible growth at very high margins and a good outlook for the rest of the year. It takes a little bit of the tension out, which also makes it a little bit less of a bellwether.
Yeah, and that's a good point, too, and particularly given the date that NVIDIA reports. I am curious, though. I mean, we still want to hear the company not only articulate what's going on with regards to this whole AI boom here in the U.S., but obviously China is still a big question mark. I know that's not going to show up in any material way in the quarter, but do you think that Jensen Huang will feel confident enough in trying to articulate where that China business might actually go?
I don't think he knows. I think that we keep going back and forth on whether we'll be able to sell anything into China in terms of NVIDIA chips. Now, long term, this is a really important question because China is at least a quarter of the market. And right now, NVIDIA has no access to it. But every time we think we know whether they'll be able to sell chips or this generation of chips or the next generation of chips, the answer keeps changing. It keeps changing in the US. It keeps changing in China. I don't think we're going to get a resolution anytime soon. So they may be able to update about how many chips they sold in the quarter, but the number's going to be very low. For the first time, it's going to be an insignificant part of their revenue, and it's an insignificant part of our expectations for the year. So we may get some updates, but it's not as big of a topic as it used to be, and as it is for the longer term outlook for NVIDIA.
Gail, before we let you go, I do just have to get your thoughts on what we saw in the software space. I mean, kind of overshadowing some of the other earnings. We're actually going to get Salesforce later tonight as well. And we talk about the downdraft that we saw in a lot of these software companies, the idea that the AI disruption will somehow make their current software suites and tools obsolete in short order here. What did you make of some of those reports that we saw kind of laying out those hypothetical scenarios?
They are hypothetical. A lot of this is still science fiction. It's not what's actually happening in the marketplace. And for many software companies, it's really hard to imagine anything's going to be any different over the next 2 or 3 years. We can have philosophical arguments about what's going to happen 5 years from now, but that's all they are. We can see what's happening in the next couple of years, which is the vast majority of software companies will continue to do well. And the market's actually given us a gift if you think about it. The valuations for software companies in 2021 were so crazy, and it's taken us 5 years to get over it. I've never wanted to talk about a software company in terms of multiples of revenue. It never made sense. It still doesn't make sense. And here we are because of this downdraft, and we have software companies trading like any other company.
Yeah.
At a multiple of their earnings, at multiples of cash flow that are far more reasonable and allow us to evaluate them. Are they good value? Are they good growth? Are they good GARP?
Yeah.
So as the dust settles, which it appears to be settling right now, we're going to have a lot of great opportunities to invest in software.
All right, Gil, we're going to catch up with you soon, I'm sure. Gil Loria, D.A. Davidson, Head of Technology Research. And, of course, speaking of software, not just a public market concern, but a private market concern as well, as a lot of those companies dip into the till to borrow for their AI fever dreams. A closer look at the world of private credit with a legend in that space. Glenn August of Oak Hill Advisors. He joins us after the break. This is
The world is running short of power. AI is accelerating global electricity demand, and supply is struggling to keep up. From high-purity polysilicon in Malaysia to wafer in Vietnam to utility-scale renewable project in the United States, we are creating energy that keeps innovation moving. Because what we build today will power the world tomorrow.
It became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is you can have results and they could come at different various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round or the finals, but you have to show up for press conferences after, before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
When you've been through these before, they're always the worst, but I can tell you there's been 15 worse ones in even my career. And therefore, I think we just need to step back, put it in perspective. This is not that big of a deal.
So this is not a rerun of 08, or in the run-up of a rerun?
It's definitely not of 08. Like, it's got nothing to do with 08.
3:30 p.m. here in New York. This is the countdown to the close. Romaine Bostic and a look back at Brookfield CEO Bruce Flatt speaking earlier on Bloomberg Television, dismissing some of the market anxiety surrounding the private credit market space. But some folks, well, they would beg to disagree. UBS analysts, those strategists out with a new report saying that private credit could see default rates hit as high as 15% if AI causes a, quote, aggressive disruption among corporate borrowers. Joining us to discuss his outlook is Glenn August. He's the founder and CEO over at Oak Hill Advisors. Glenn, great to see you here.
Good to see you too.
It's great that we had Bruce Flatt on, and now you, because both of you have been through several market cycles, including the dot-com boom and bust. And Francine asked him a question about whether this was a repeat of what we saw in 08, 09. Flatt was pretty dismissive of that idea.
I agree with Bruce that this is not 08, 09, because 08, 09 was a question of the existential question of the entire financial system. This is a portion of the economy, but it's a large portion of the economy. So if we think about software in the credit markets, whether it is 15% of the leveraged loan index, 7% of the high yield index, 20 plus minus percent in private credit, it's a meaningful portion, but it's 80, 85, 90 plus non-software. Now, again, to me, there's been so much talk about what does this mean for private credit. I think it's much bigger. I think there is this question here of what does AI mean for all industry. IBM stock, forget about the credit markets. IBM stock is down a third, $80 billion over the last few months, over the last 6 weeks, I think, because of concern about a new tool.
Right.
Okay, you have Oracle, Microsoft, you have this S&P 500 software index down 30%. These are the biggest software names in the world. And so this is not about credit markets. Credits have a portion of this, just like the S&P 500 has a big portion in technology. So to me, the question is that everyone is asking is how will AI affect large corporate equities, credit? And so that's where it ripples into what we're doing.
On the credit space, though, but you understand some of the fears, too, particularly the difference between credit and equities. The idea is that, if there is a shock, if you're in the equity market, in theory, you can bail out pretty much overnight. There's a duration risk that is kind of baked into a lot of what you do.
You have to separate liquidity risk with credit risk. Okay, so let's just go there.
All right.
So, yes, in private credit, those investments are generally in vehicles that are locked up to match longer-term investing by investors. Just like private equity, longer-term vehicles where you get incremental return for that illiquidity. The public markets, obviously, you can sell. But the big difference, what I would say, is the credit risk. When we invest in credit, in software, in anything we do, we're typically investing in the first 20, 30, 40% loan to value. So we have 60, 70, 80% equity cushion below us. So stocks in the software space generally are down 30%. Okay, so our loan to value that might have been 30 over 100 now might be 30 over 70. But we still have substantial cushion by being senior. And I think one of the things that's being missed here is, again, equities are down because of long-term growth trajectory. Our investments are typically 3, 4, 5 years of debt with a very substantial coupon. And so the impact of AI is not going to be felt today. It's going to be over the next number of years. And by the way, it's going to be felt very differently by all the different companies. They're going to be like any other business. There's winners and losers. There's some that have protective moats, and there's some that don't.
Well, that's what I want to talk about too. I mean, there's been so much focus on the downside of AI on these companies. Where is the potential upside, particularly in the type of companies you invest in?
Well, there's no doubt that the ability to get leverage from AI agents can ultimately reduce costs, improve quality, and potentially give you the ability to lower price. We have a large software portfolio, we have a large services portfolio, we have a large portfolio in general, over $100 billion of capital. We have our own business where we run $100 billion of capital. We're asking ourselves every day, how can we use AI to get better, faster, more efficient? We actually had an internal AI contest yesterday where we had 9 different teams in our firm present ways that we could save money and do what we do better. And so to me, every company right now is asking that question. And what we're dealing with in the markets, and I agree with Bruce earlier, there is this panic that AI is going to just take out every single company. And the answer is it will some. It will have an impact on some. Some of them, it can be a complement, enable that provider of software to upsell and provide other services. So I don't think it's all lose. I think there's a lot of winners that can use AI and increase their returns.
I want to talk a little bit more about your business. You mentioned more than $100 billion in assets. Like a third of that is what leverage loans. Another fifth or so is what CLOs and multi-strat credit strategies. With regards to the leverage loan and CLO space here, we've seen a lot of activity there. Certainly, I think it was a record in CLOs last year in 2025. That continues in 2026?
Well, the asset class has become institutionalized. It is a proven asset class. The structures work. We dealt with 08, 09. We dealt with COVID. And we dealt with all the different crises and challenges and mini crises over the years. So the asset class has been institutionalized. I will say, since the leverage loan market has approximately 15% today in software, there's a little anxiety, and the cost of financing has gone up. But in many respects, it's actually created some interesting opportunities to invest new capital and basically buy at discounts today and create higher returns on equity. So we raised $1.1 billion of equity capital last year to do over $10 to $15 billion of transactions. And I say there's never been more interest in the asset class. But again, when you have this shock to the system, and again, whether it's in the private credit market, the loan market, the public equity market, you're going to see it across the sector.
So you feel confident enough that if you had to make a loan, if you were presented with the opportunity to make a loan to a software company or a company with AI exposure, you would feel comfortable doing that?
The answer is every company is different. The answer is 100% yes for the companies that we do our work, and we believe they're going to be able to navigate.
Are you turning away a lot of companies
We've always turned away. I mean, if you
more
look
so
at
than normal?
I would say that we have been, again, we've built a business over the last 38 years, hundreds of billions of dollars investment, and people give us capital because they believe in our ability to pick credit. And there are hundreds of companies, and we have turned down in software space, but across everything we do, we've turned down 50, 60, 70, 80+% of everything we see. We're ultimately trying to maximize risk-adjusted returns, which is why over a long period of time, our default rates are fractions of the market. And then our ability to work through stress, which is important because we will have some stress in software, we'll have stress in other places. our ability to work through distressed situations, I think, is really important.
We started the conversation kind of referencing Bruce Flatt and the question about a repeat of 08. I mean, you've been doing this, as you said, for more than 3 decades. So you were through the dot-com boom and bust as well. Are there parallels to that?
Yeah, look, the dot-com is less relevant. At that point in time, the private equity leverage finance market was doing much more in industrial companies. Yes, there was level 3. Yes, there was WorldCom. But by and large, it was not a dot-com market. I think the period of time that feels most comparable to me, although there's differences, is the energy market in 2014, 15, 16, when the Saudis decided that they were not happy that shale producers were flooding the market, and they said, we're going to turn up production, which brought oil prices down from 98 to 50, and then ultimately to high 20s. And the high yield market at that point in time, 15, 16% plus minus, was in the energy space. And so like the software market today being at 15%, for example, of the loan market, so you had this shock. The thing that made that period more easier than today is you could actually do your analysis and say, this company can make money at $30 oil, this company will lose money at $50 oil. And you could basically make your investments based on that judgment. Here, we're actually arguing against a hypothetical new tool that Anthropic or OpenAI might come out with in 6 months or 2 years. And so you have to just test, and we continually re-underwrite our portfolio to test where there's exposure and be real time because this market's moving quickly.
All right, Glenn, this is a great conversation. I can keep going. My producer's yelling in my ear that we have to go. We got to get you back. Glenn August, founder, CEO over at Oak Hill Advisors. When we come back and check in on the consumers and the housing market as part of our Stock of the Hour. This is Bloomberg.
The world is running short of power. AI is accelerating global electricity demand, and supply is struggling to keep up. From high-purity polysilicon in Malaysia to wafer in Vietnam to utility-scale renewable project in the United States, we are creating energy that keeps innovation moving. Because what we build today will power the world tomorrow.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
All right, it's time now for our stock of the hour, and you get a two for today. Home Depot shares down a couple of percentage points. Lowe's down about 5 percentage points after the home improvement change flagged economic uncertainty among homeowners. A lot of concerns right now here as to whether what we heard out of these companies is a read-through to the broader economy. Nora Melinda joining us right now, our markets correspondent here at Bloomberg TV. All right, first, there's the numbers that we got out of them, and then there's the commentary, and then the third leg of that is the market reaction. Where do we start?
Well, I want to dig into the market reaction because we do know that we're kind of in this space right now where we're seeing a consumer that's incredibly stretched. That's something that we've been hearing quarter after quarter from a lot of these real estate companies. We know the macro environmental landscape right now is really keeping us at what a 30-year fixed mortgage right now is about 6%.
Yeah.
So that's lower than it was in the past, but it's still incredibly high for a lot of people who are out buying new homes. If you think about Lowe's and Home Depot, those are companies that are home improvement companies. So you don't see as many people doing those big ticket purchases to fix up their house or put in the kind of upgrades, maybe changing their kitchen out in the same way that they did in the past.
And this gets to a question too, because I noticed also home builder stocks as a group were also taking it on the chin. This also seemed to be tied to the State of the Union and I guess the lack of any sort of real policy change when it comes to the housing market.
Well, I mean, affordability has really been the word. And we see the Trump administration, we see both parties, Democrats and Republicans, really talking so much about affordability or the lack of affordability for consumers at the State of the Union address last night. A lot of people were expecting, at least when they were focusing on real estate, expecting him to speak more about his housing policies. We do know that his administration has flirted with multiple things, whether it's the 50-year mortgage. We've also talked about the ban on institutional investors buying single-family homes. In the speech, he only really mentioned the institutional investor ban in terms of single-family homes, but he didn't really spell out what other plans and policies they intend to implement that should actually bring costs down for homeowners or prospective buyers.
Yeah, it'll be interesting too. We're going to, I think in next week or two, we're going to get some earnings out of like furniture makers and other kind of stocks that would be tied to the housing market. But I just thought it was interesting too, Nora. We actually saw, wasn't there a story today that mortgage rates are now back down to the lowest since 2022, which I know isn't that far ago, but
yeah, but I mean, it's definitely about the sentiment too.
Yeah.
You got the data, you got the eco data that we continue to see, but then there's also the sentiment on Main Street.
All right, Lowe's and Home Depot among two of the more notable decliners here on the day as we move closer to the closing bells and closer to those earnings from NVIDIA. When we come back, Amy Wu Silverman joins us here in Studio 2. A closer look at the derivatives market out of their equity derivatives strategist at RBC.
The world is running short of power. AI is accelerating global electricity demand, and supply is struggling to keep up. From high-purity polysilicon in Malaysia to wafer in Vietnam to utility-scale renewable project in the United States, we are creating energy that keeps innovation moving. Because what we build today will power the world tomorrow.
build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more. But I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh, yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
When you look at earnings of these Mag 7 companies, they are being punished for having that AI capex upside surprise if that is exceeding the revenue surprise. So investors are getting a little bit more scrutinizing about that overall spend and therefore thinking about, well, who's the beneficiary of that spend?
Mira Pandit, global market strategist at JP Morgan Asset Management, kicked us off to the close just about 50 minutes ago with a pretty sizable rally on our hands in broad U.S. equity markets. In fact, as we speak, stocks pretty much around session highs with the S&P up about 0.9%, but it's the NASDAQ out front. The NASDAQ composite up about 1.3%, the 100 up about 1.5%. Chip stocks and software stocks getting a little bit of their mojo back here on this Wednesday afternoon. And of course, that's ahead of a big earnings report by NVIDIA, which is up for a fourth straight day, a rare of 4 days of gains. In fact, the first time we've seen 4 straight days of gains for that stock since at least mid to late December. Joining us now around the desk in Studio 2 is Amy Wu Silverman, equity derivative strategist over at RBC Capital Markets. All right, Amy, before we get to NVIDIA, I do want to go back in time a little bit and just talk about all of this anxiety that we've seen around anything with a potential exposure, negative exposure to AI. Every time somebody comes out with some random hypothetical report about what the AI disruption will be, we see this massive sell-off in software stocks and IBM and everything else here. I am curious exactly what investors are so skittish about, because most of these reports have just been hypotheticals.
Yeah, I think the issue is there are no sacred cows. Like, nothing is off limits. You know, you could be sitting pretty in industrials or financials or software. They can come get you. And so I have this horrible analogy, the lice test. But, what I was really thinking, Romaine, was, what do you have to go strand by strand, stock by stock through and comb through idiosyncratically to say, hey, can AI get you? Because, again, I think nothing is sacred. That's why you've really seen a flip of the left tail dominating the story this year.
Yeah, it brings back some nightmares from my childhood there. So not cockroaches, but the lice test. But it gets to this point, too, that some people say this has actually been somewhat healthy, because the AI trade was basically a beta trade for the last few years. You just throw a dart at the board at NVIDIA, Microsoft, whoever, you were going to make money. And now you do have to be a little bit more scrutinous. But that's creating a lot of volatility in between, both on a single stock basis, I would think, but also on a broad market basis, or no?
Yeah, so what's interesting is average single stock volatility is really kind of at highs, and then that spread to index volatility is actually the biggest gap ever. So we've called this for a while. We've called it the paddling duck market, because it's a lot of that furious duck feet under the surface. I mean, you have a VIX that's kind of sub 20 most of the time, right? Yeah. Doesn't feel that way, but is. But you're getting a lot of zigging and zagging. That might cancel out your index volatility, but average single stock vol has been really idiosyncratically high, again, because I think nothing is sacred, and that's why people are skittish.
When we talk about the importance of a stock like NVIDIA to this market, obviously the highest weighting out there, and also just, you talk about its business dealings. I mean, it seems to be doing business with everybody, or at least every other big heavyweight name in the indices. Do we have to worry about that interconnectedness? I don't know what the correlations show right now, but is that something that investors should be concerned about?
I think so, and I think they are. My favorite meme is that of the surge protector kind of plugged into itself. So you think about the AI capex incestuousness.
You've got a lot of great analogies today.
That picture always comes to my mind when we think about it. What I think is so interesting about the narrative of NVIDIA right now is options are pricing a nothing burger. They're pricing kind of a plus or minus 5% options price today versus think about what the stock has moved in the past. It's really quite shocking. The other part of the narrative that is interesting is this has typically been a very right tail stock where there's explosiveness and calls to the upside. That certainly has not been the case. But I think inflection points can change on a dime, and that certainly can happen with NVIDIA tonight.
Is that because people are kind of over it, or have they just moved on to other stocks and maybe where they think, and I'm talking primarily in the option space, where they think there is just a little bit more of a potential pop?
Yeah, I think we're not quite at the level of bargain basement hunting in software IGV, for instance, but I do think investors have moved on either on the downside or the upside to names outside the hyperscalers. So, that could be your SaaS names, it could be your semis, but we've seen this. Everything was Mag 7, everything was that concentration risk, and that to that degree has breadth widened this year, and that's been much of the story.
With regards to just flows and this rotation out of some of the big cap tech, maybe into some slightly smaller cap tech, and more importantly into non-tech names here, what is that telling you? Not only just about the direction of the market, but sentiment as well.
So one thing investors have really done when you look at what has outperformed recently is they're starting to, again, go stock by stock and say, well, what can AI not disintermediate today? Maybe something that has physical assets versus something being asset light. And then there's sort of a U.S. versus ex-U.S. trade going on as well. So year to date, there's been these rotations, again, very under the surface. That's why you've seen high average single stock volatility. But it hasn't just been a Mag 7 hyperscaler story anymore, which to some degree I think is healthy, right? That's good news.
Well, the U.S. versus the rest of the world is interesting too. We should point out emerging market stocks outperforming on the day. And it was funny, this morning I came in, I was asking some of our Bloomberg intelligence analysts about kind of what to watch in NVIDIA's earnings, and they were actually talking about the dollar and the FX market, and I was like, what, really? And they kind of had to explain to me just how that has become much more of a factor because of how much people have jumped across the border.
They really have, and you see it in options too. So you see it in the call options of an FXI or EEM or EFA that has really changed the volatility landscape, even from, I would say, 4 to 6 months ago.
Yeah. So going forward, I mean, let's put it NVIDIA aside. I mean, we'll get past the earnings tonight, and the market reaction is what it is. Is there anything else out there right now? I mean, is there a macro story that potentially drives this market, or is this just pretty much all about that long-term structural AI trade and the earnings that potentially go with it?
So one thing I will say is it has very much been a left tail narrative this entire market year to date, which really is a flip from the right tail story it was last year. And what I would watch is people can get comfortable that retail bid coming back into the market. That's really been our third leg of the stool. That could really, again, change narrative. The second part is correlations. Again, this dispersion trade of single stock versus index volatility has been very wide. If we get a geopolitical risk event in Iran or something where it's a highly correlated move, that could change the narrative of the market as well.
I think I ask this every time you've been on as of late here, but are you seeing any material hedging to the downside?
There definitely is now. And that's been a huge shift. There absolutely is, to the point where that's all they've been fixated on, and I'm curious when they'll change back to kind of the MOMO, FOMO of the past few years.
Have the prices gotten, meaning prices to protect, has that gotten pretty high?
It has. It has gotten expensive, certainly on a year-to-date basis, but even on a 5-year basis, you're starting to see it move to above average levels.
All right, Amy, always a great conversation. Amy Wu Silverman is equity derivative strategist over at RBC Capital Markets, counting us down to the closing bell here on this Wednesday afternoon. Stocks in the green across the board, near the highs of the day, but at least on a percentage basis, the leaders, they're not actually those big cap tech names. Yeah, you have a few in there like Western Digital and AppLovin, and a bit of a rebound rally in some of those beaten down names, but you also still have a lot of those names in the broader economic space, if you will. Cyclical stocks as we count down to the earnings out of NVIDIA coming up after the bell. Full coverage starts now.
The closing bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here, taking you through to the closing bell with a global simulcast. It starts right now. Carol Massar and Tim Senovic join us from the radio room. Caroline Hyde, the co-host of B-Tech, joins us as well as we now drumbeat to those results quarterly earnings out of the largest company in the world and probably, at least for right now, the most consequential, NVIDIA.
Yeah, NVIDIA, and looking at it actually trading off its highs of this session as we've just got a few minutes left in the trading session, but still up about 1.5% today.
Not just NVIDIA, we'll get a check on some of the software companies, Caroline, of course, following these closely. Salesforce reporting, Snowflake reporting. We'll get Zoom earnings after the bell as well. So yes, today is all about NVIDIA, but let's not forget about some of those humble software companies.
And maybe NVIDIA and Jensen Huang has a few choice words for software. And indeed, remember, he's been trying to convince the market that it's totally irrational, illogical to be selling them off and thinking AI is going to eat their lunch. But we've got a lot to hear from the CEOs of Snowflake and CRM of Salesforce to really prove that the negative, that they're not being disrupted in the way that they think.
Well, this is what I am curious about, Caroline. I mean, we kind of know what the numbers are going to be. 68% jump in revenue, 72% jump in adjusted EPS, and a gross margin at 75%. That's phenomenal by any stretch of the imagination.
For a $4.8 trillion company?
I know. Normally, I mean, you would think, okay, if you post those numbers, the stock should pop 20%, but this is a stock that's up 700-800% over the last 3 years, Caroline. I mean, what can Jensen Huang actually say that you think would materially be an upside for the stock?
Margins. Can they improve on margins? Are they seeing Rubin, Blackwell go along in terms of, well, the supply chain that they're seeing? And more broadly, what about China? Still the key question mark.
Caroline Hyde in the co-pilot seat for us as we have a lot of tech earnings to parse here in the after-hours trade. Let's walk through the numbers in the cash session with the S&P 500 higher by almost 60 points or 0.8%. The Dow adding 300 points or 0.6%. The NASDAQ composite up about 1.3. NASDAQ 100, 1.4. The Russell 2000, Carol Master, higher by 0.4%.
All right, good stuff, Romaine. Looking at the S&P 500, kind of an even split, guys. 258 names in the index to the upside, Caroline. 244 to the downside, one unchanged.
And look at that for once. IT, information technology, actually an outperformer on the S&P 500. In fact, the NASDAQ 100 managed to push itself into positive territory today. We're currently seeing financials on a bit of a tear as well, up 1.7%. Communication services did well. And that consumer discretionary, Romaine, that you were pointing out a little bit earlier.
Absolutely.
All right, guys, let's get to some individual gainers as we await some earnings to cross the Bloomberg terminal. I'm going to go to one that was the number one gainer in both the S&P 500, NASDAQ 100. We're talking about Axon. It's the maker of tasers and also public safety software. They reported an adjusted EPS for the fourth quarter that beat the average estimate. So this one up remains 17.5%. We got to go to Salesforce.
Salesforce earnings crossing the wire. I'm going to start off with the forecast for the current quarter, the fiscal first quarter. The company sees revenue of about $11 billion to $11.1 billion. The low end of that range, higher than the average of street estimates of about $10.99 billion. For the current quarter, or the quarter that just passed, excuse me, the company reported $11.2 billion, slightly above what the street was looking for. Adjusted EPS also came in above what the street was looking for at $3.81. The average of estimates was $3.05. And Caroline, the company also saying that it plans to increase its share buyback authorization to $50 billion.
And maybe, Tim, that is what the investor base wants to hear. If that's the proof point, look, believe in us. We're believing in our own stock. We think we're so beaten up, more than 40% in the last 12 months. We're going to be buying back to up to $50 billion. There, they're trying to perhaps tempt people to start to figure on catching a falling knife.
And also trying to get people to think of Salesforce increasingly as an agentic AI company. Mark Benioff, chair and CEO, saying, quote, "We've rebuilt Salesforce to become the operating system for the agentic enterprise, bringing humans and agents together on one trusted platform. And the more intelligence moves to where work happens, the more valuable Salesforce becomes." The question is, can it convince investors that it is a company for the AI era?
You know, having said that, it's a stock that, as we know, has been under pressure, down almost 30% here in 2026 already. The stock is down about 50% since late December, or I should say late in 2024, December of 2024. So it has been pulling back dramatically. And now you can see the stock in the aftermarket down about 2%. This is despite increasing its share buyback authorization to $50 billion. And again, going to that first quarter revenue, 11.03 to 11.08 billion. That is above the street estimate of 10.99 billion. Not enough, though, and to impress investors, at least in that early aftermarket trade.
This also gets to the idea, though, too, of just how important the conference calls are actually going to be here. And I do kind of wonder, I mean, it's kind of dueling conference calls because both Salesforce and NVIDIA start at the same time. Caroline, who are you going to listen to?
Hopefully we can spread across both. I'm going to be sitting next to you, Romaine. I'm going to be dialing into what Ed's listening to on NVIDIA and what we're all listening to on CRM. But what I think is interesting is Agent Force. This is where we're seeing agents being deployed by CRM and what we're seeing in terms of the upselling, what we're seeing in terms of adoption. They say their average revenue run rate has reached $800 million, up 169% year over year. They've closed 29,000 deals, up 50% Q on Q. Is that enough to show that their offerings in terms of agentic AI is enough to secure the amount of money and the amount of seats that they need people to still keep on paying for?
Well, Salesforce shares down about 2.75, 3% in the after hours. Trade Desk shares down 10% in the after hours. Make that 12% at this point. This after the first quarter forecast missed estimates. First quarter revenue coming in at least at $678 million. The estimate was for $688.8 million. First quarter adjusted EBITDA, this is the guidance, about $195 million. The estimate was for $222.7 million. Shares continuing to move lower, down about 12.6% in the after hours.
Yeah, and that's on top of already about a 34% decline in shares of Trade Desk here in 2026. I should point out about 10% of the float is short, so any kind of negative, maybe the shorts kind of have it right, but you're definitely seeing the stock down almost another 12% here in the aftermarket.
Yeah, and it gets to this idea too. I mean, we talk about the idea of what these ad tech platforms are doing and the idea of a lot of the money flowing away from some of the more single players in that space and to, I guess, some of those bigger tech companies that, of course, have their own already baked into it. It'll be interesting. That's actually a conference call I'd be interested to be a fly on the wall on as well.
All right. People are pretty positive on all of these companies. When you're looking at the analyst recommendations, 22 say buy on Trade Desk, only 3 say sell. The price target is well above where they currently trade, at some $46. So where are they going to be able to convince the market that you can start adding to these names amid the disruption in AI angst, let's call it?
All right, we're talking a lot about technology. Let's go to a retailer. A little bit of lightness, perhaps. Urban Outfitters out with their results. Fourth quarter EPS, $1.05 a share. Fourth quarter adjusted EPS, that's coming in better what the street was expecting. $1.43 a share versus $1.26. And fourth quarter comp retail segment sales up about 5.5%. That's a beat too in terms of what the street was expecting remain. And the stock's up about 1.5% here in the aftermarket.
Let's go back to tech. Snowflake shares higher in the after hours trade here. The company saying that first quarter product revenue, in its words, will be in a range of $1.26 to $1.27 billion. That's pretty much on the nose of what the street was expecting. That's coming on the heels of a fourth quarter revenue of about $1.28 billion, slightly higher than what the street was looking for. For the full year, the company says expect about $5.66 billion in revenue. The street was looking for $5.54. The company also says adjusted operating margin for the full year, 12.5%. So at least on the margins here, it looks like a relatively in-line quarter and a slight guide higher for the full year.
Let's check out Zoom Communications because, look, revenue beats both in its fiscal quarter reported and its full year guidance, but not so much if you're looking at the profitability. They're really seeing 2027 adjusted earnings per share coming in at $5.77 to $5.81. Now, the market wanted to see $6.06. Zoom, though, did see that 2027 revenue will be in the range of 5.07 to 5.08. That was a beat compared to the expectations. And for their fourth quarter, we saw online revenue up 2.6% year on year. And you also saw a beat in terms of their revenue. But again, earnings per share falling short. This is a company that's having to invest in itself, trying to again convince people that stick with our product, stick with the conferencing, stick with the AI that we've already integrated. But they're probably having to spend a bit on that. We're seeing cash and cash equivalents falling some 6%.
Well, I'm looking at shares of Paramount Skydance down about 1.6%. We're getting some results from the company, not everything at this point. In terms of that outlook, Paramount Skydance sees fiscal year revenue at $30 billion. A look back, fourth quarter year-over-year Paramount Plus revenue up 17%. Fourth quarter revenue coming in just above estimates at $8.15 billion. Fourth quarter loss per share from continued operations at 52 cents. Fourth quarter operating loss at $339 million. Estimate was for a profit of $309.3 million. Shares down about 1.6%. The real story with this company, though, is does it get those assets from Warner Brothers Discovery, or does Netflix win out? Shares down about 1.6%.
All right, let's go to the company behind WWE and so much more, those live events. We're talking about TKO out with their results. Fourth quarter total revenue coming in slightly above the street estimated $1.04 billion. If you go to WWE adjusted EBITDA, that was better than the street was expecting, $165 million. UFC revenue, $401.4 million. Again, that was better than what the street was expected. And fourth quarter adjusted EBITDA coming in better than what the street was expecting. But stock's still down about 2.3% here in the aftermarket. All right, that's a wrap. Our earnings as we count down. NVIDIA just about 10 minutes away. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Caroline and Romaine, of course, continuing there on the close on Bloomberg TV. Tim and I continuing right here on Bloomberg Business Week Daily. Folks, we'll see you again, same time, same place tomorrow.
All right, a quick break and a little bit of a drink of water here as we count you down to those NVIDIA results. Stick around. This is Bloomberg.
The world is running short of power. AI is accelerating global electricity demand, and supply is struggling to keep up. From high-purity polysilicon in Malaysia to wafer in Vietnam to utility-scale renewable project in the United States, we are creating energy that keeps innovation moving. Because what we build today will power the world tomorrow.
Live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next?
On this episode, we're a major mining economy. We are a child when it comes to general mining, and so it's exciting time to try to draw more investors into mining and so on.
Premieres February 27th, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Caroline Hyde.
And I'm Romaine Bostic. Great to see you, my old friend, here on a really great day for the markets after a lot of those rumblings around some of the sell-off in the software stocks, at least for one day, getting their mojo back. The Mag 7 up about 1.5%. The S&P 500 up about 0.8%. There was some weakness there on the day, but that was largely in the consumer space, largely around home builders coming off those earnings. Somewhat disappointing earnings and guidance out of Home Depot and Lowe's. Even Bitcoin getting a bit of its mojo back, though Caroline's still pinned below 70,000.
Tell you what's getting a mojo back. Maybe some of these software names. Let's just dig into Snowflake, up 2%, coming off at the highs. It did manage to rally about 5% in earlier after-hours trade after its numbers hit, and it manages to say 2027 product revenue. It's going to be higher than you anticipated. Remember, Sridhar Ramaswamy, the CEO of this company, really understands AI. He was building a startup, Neva, that got bought by Snowflake. He's trying to say that with my data, with my focus on agentic AI, you can continue to win. I won't be disrupted. Meanwhile, Salesforce not proving that point. It seems to be a bit of a disappointing guide in terms of revenue, down 2.5%. What will they say on the call? Remain, we're basically up 0.6% on Paramount's guidance. Look, the question for them across the call is M&A. What's happening in terms of Warner Brothers Discovery?
Absolutely. A lot going on to parse here, and that actually brings us to our top story right now. With the countdown to the close over, the countdown to NVIDIA's earnings, that actually begins. High stakes for the chip maker, high stakes for the buyers of those chips, high stakes for the endless list of industries investors seem to have posited that could be helped or hurt by AI. It's also potentially high stakes for the economy, too. A St. Louis Fed survey just last month showed investments in AI-related categories has actually now surpassed the contribution of IT components to real GDP growth during the dot-com boom. Now, this creates opportunity, particularly for those that invest outside the direct world of AI, but it also raises risk when it comes to the interdependency on that phenomenal AI spin. And that's why we wanted to kick off our coverage of this hour with Victor Khosla, founder and CEO of Strategic Value Partners. It's an alternative asset firm whose investments grounded in the real economy, but certainly you still obviously got some degree of exposure to a lot of the technological waves going on out there.
Of course we do.
Yeah. We'll talk a little bit about kind of the risk and opportunities that have cropped up. We can certainly see it in public markets. Private markets has also seen a little bit of ruction as well.
Our world, Romain, as you know, is credit markets. Over the course of even the last 18 months, 24 months, underneath the surface, it is really wobbly. We have 6% default rates in high yield. Moody's numbers, elevated numbers for the last 2 years. So even before we are hitting this current wave of issues with software and what it'll do, even before that, there was just underneath the surface a lot of stuff going on.
Is there any sort of contagion risk, though? I mean, we heard earlier on Bloomberg Television, Bruce Flatt over at Brookfield, Glenn August over at Oak Hill, kind of saying that, look, there is something going on under the surface, but nothing widespread in terms of risk.
It's not systemic.
Okay.
The credit markets, the high-yield credit markets, the broad definition, $5.5 trillion.
That's,
by the way,
a drop in the bucket. That's NVIDIA's market cap, isn't it?
Yeah, exactly right. And crypto, you've lost, I don't know, a few $1 trillion over the last few months. Nobody seems to care that much, right? So you don't want to overdo kind of what happens if there are credit problems in terms of broader systemic risk. I do think, though, software is a big stick. The credit market has had all these sticks being dropped on it, and one day it'll really buckle. And software is a big stick. And Caroline, forgive me, just so to put it in perspective, in 2015, 2016, we had a energy crash. Equity markets headline equity markets didn't do very much. Energy was 15% of the high yield index. And it took high yield spreads up to 900 basis points, entire market. High yield spreads today are 300. So the contagion risk in credit, worry about it.
Worry about it when UBS strategists are saying we could see a 15% AI trigger default rate surge across debt markets. Direct lenders in particular, they say, have it financed software companies to the 40% of all sponsor-backed loans. So is that the contagion risk? Is that the issue? When do we start to see transparency on that?
No, I think somebody like a UBS, and believe me, I read that report closely. That is their worst case scenario.
Okay.
Right? So one can't just, when you look at kind of how all of us invest, we build a base case, and then we kind of build tail risks to it.
Yes.
I think the one thing I would walk away with today, the tail risk in credit is fat.
Wow.
This is a fat tail risk now. It's no longer a normal tail risk. And something like software, how big a problem it is, I don't think we even quite know yet.
So Victor, are you therefore believing in many ways that software is exposed as much as the market fears to AI disruption? Like Snowflake managing to push it off. We've heard NVIDIA CEO Jensen Huang saying it's illogical to think AI is going to destroy all of software.
It's logical to think it's going to destroy clearly segments of the software business, not all of it. And if those segments, if companies have bought, if private equity firms have bought software businesses at 20+ times cash flow, relying on growth, you are going to see large pockets of problems. But the 15% default rate, the UBS number, I think can get kind of a little overdone.
But when we talk about the potential risk or the disruption here, I mean, there's also a time frame element. And that's a Trini report rattled people partly because they were saying basically 2028, which is just around the corner. I know it's hard to look into your crystal ball and put a time frame for that disruption. But does that time frame end up being maybe a little longer than the duration of some of these credit assets?
Look, we have, over the course of the last year and a half, we are redrawing the geopolitical map of the world, right? Just in terms of how it works. there is such a huge differentiation between AI and tech valuations and real economy business valuations. So all this is coming with that. So I think, look, I do believe the U.S. economy can take a lot of buffeting.
Right.
But so I'm less concerned about the U.S. economy going into some deep, dark recession.
Right.
More concerned that credit at 300 basis point spreads, which is kind of close to record lows today, is mispriced.
That's mispriced.
It is mispriced.
How does that correct? If at all?
It widens out.
Well, yeah, I know it widens out all at once or very slowly.
We generally find these things, these are 3-6 month things when they happen. It's not instantaneous.
Why are you saying this with a smile on your face?
Oh, God.
There's always opportunity amid volatility.
It's what we do. Right? So we're in the business of lending money to help people tide over issues, hybrid capital, junior capital at 15%. Or we're in the business of kind of taking over businesses, running them and improving them. And for us, that opportunity pipeline, right, builds up.
That's why I'm smiling.
How would you compare the opportunities you're seeing now relative to, I don't know, even say 5 years ago?
In early 2022, before the Fed really started to kind of hike rates, our pipeline was $75 billion. We've got $23 billion of capital. It was our pipeline, curated pipeline, was about 100 deals and $75 billion. Today, it's $300 billion.
All right, we're in conversation right now with Victor Khosla, founder and CIO over at Strategic Value Partners. He's sticking around with us as we await, Caroline, those numbers out of NVIDIA. We've kind of reiterated the actual numbers for the quarter, which isn't going to really be a surprise. Gil Luria was on earlier, D.A. Davidson. He made a great point here. Because of how late they report in the cycle and because all their customers are Microsoft, Meta, and all these others, we kind of have a general sense of what they're going to do. 68% revenue growth, phenomenal.
There has been some anxiety coming from maybe Lynx Equities, who says, look, maybe not all of the capital expenditure that you're seeing from these hyperscalers is going towards GPUs and CPUs. A lot of it goes towards energy. And then you've also got the worry of what really is OpenAI looking to spend? How much are they committing? Because that's a huge exposure for the likes of NVIDIA. But then if Meta is also doing deals with AMD, if you've got Amazon using their own chips, if everyone's TPU crazy, how much is that going to be a long-term issue for NVIDIA? But you're right, at the moment, the fact that a $4.8 trillion company is getting anywhere near a 60% growth in revenue is extraordinary.
And we're going to talk a little bit later about the debt side of this as well. Because, I mean, we get these big numbers, and you cover this on BTech every day, these gigantic commitments, but they're still, it's not necessarily cash being kind of taken out the wallet. I mean, they got to find the cash somewhere. Some of the companies have it on their balance sheet, but as we've seen, even the companies that have it on their balance sheet are going to the debt markets. How long are the debt markets going to be receptive to that type of borrowing?
Particularly to the neoclouds. We've got CoreWeave coming out tomorrow after the bell. How much are they still having to be very clever in which the way they finance some of these new data centers? We know that Meta and Alphabet and all the hyperscalers can issue debt and then some, and people will lap it up. But what more broadly of the deal, how many times can AMD sell its shares to be able to win over a new client? It's a key question.
We are still waiting on those numbers out of NVIDIA. If we can, I do want to bring Victor Khosla back into the conversation, particularly on that last point that Caroline was getting at, this idea of debt. And I know that you're not lending at that scale of what some of these companies look for, but I am curious that if a software company, a hyperscaler, somebody came to you and presented an opportunity where they needed the money, I mean, would you feel comfortable lending to them or taking an investment?
These guys are issuing debt in the investment grade markets, very tight spreads. We don't get out of bed until we can make 15%. Right?
All right, Naima Campbell.
This is not really us.
We should point out you do a lot of high yield and things like that as well.
Some of these neoclouds are getting into the field of high yield. I mean, and software companies might end up being there if they suddenly get start to be shut out of the market in some way.
Yeah, and it gets to the idea though too, and I do kind of want to link this back to some of the more real economy because AI has kind of infiltrated everything. It's not just really about building data centers anymore. I mean, we're seeing, we had the trucking market got rattled a couple weeks ago because some karaoke maker decided it could, had a better model. So it gets to this idea that the companies that you wouldn't even have thought would have been exposed to software or AI may now, at least in theory, have some exposure to that.
Or, we are a large investor in a steel company in Europe.
Okay.
It's got round numbers about 500 million or so of EBITDA. So it's a good size business.
Yeah.
We think the AI opportunity to buy better, to buy better scrap metal, which is kind of what you need. And there are a few other places it can be relevant, creates 50 million, 75 million even in EBITDA or cash flow. Big numbers. Industrial manufacturing company. And by the way, if you're invested in some of these businesses, you've got to invest to get that value because your competitors will.
Where are you in terms of the so bullish it's bearish narrative? The idea that AI is going to be so enhancing of productivity for your steel maker that it eradicates white collar and blue collar work and it starts to impact the broader economy. And I know you're someone who thinks a lot about the broader economy and the K-shape.
One of the primary places we think AI comes is in these knowledge businesses. And when you look at kind of what we invest, 40% is real assets, power plants, airplanes, real estate, toll roads, right? Just so you kind of get a sense.
Real infrastructure.
Real assets, right?
Yeah.
So much of our business is investing in these kind of places. So when we look at kind of, we are not in the high knowledge growth game, which is where we think the largest parts of the disruption are going to come.
Victor, always a pleasure to have you. We were kind of hoping NVIDIA would cross the wire while you're here, but a little bit delayed, but still some great insights, fantastic insights out of Victor Khosla, founder and CIO over at Strategic Value Partners. Caroline, we brought you on this program to help with NVIDIA. Are you jinxing it? What's happening?
I'm having a chat with them. I'm not really. Well, we know. Do you remember that time Meta was about half an hour delayed? I mean, we all used to the Elon Musk. Who knows when Tesla's going to drop? But at the moment, maybe we're just dotting our I's, crossing our T's, and getting us a little bit fired up for our Super Bowl remain.
All right. Well, maybe Jensen's got to iron out that leather jacket here. We continue our coverage as we await those earnings out of NVIDIA. Let's bring Matt Bryson into the conversation, Managing Director of Equity Research over at Wedbush Securities. All right, Matt, let's start off with what your expectations are. I mean, we know the numbers, but I mean, what do you actually want to hear this company articulate later tonight?
I mean, I want to see them beat and raise again, right? They seem to beat and raise every quarter. They're certainly this time around, you've got the setup. You've got all the hyperscalers having increased their CapEx spend. So that's what I want to see.
How resilient is that market share of NVIDIA for that CapEx spend? As we start to see Meta turn to an AMD, as we start to see them all looking at their own ASICs and their own purpose-built chips, how much can NVIDIA in the longer term be still so dominant in the market?
So longer term is hard because things change 2, 3 years, 5 years out. I mean, we're talking about things like quantum now coming into being in 2030. And so it's always been hard to say what's going to happen 18 to 24 months away. Having said that, I think right now you don't have a choice. And in part, we've got some component shortages that don't look like they're being alleviated through 27. So whether it's the TSM with CoWoS or wafer supply, whether it's HBM DRAM, and certainly over the next 12 months, I think NVIDIA has done a better job than anyone else in terms of setting up procurement. And so even if I'm Google and Gemini's going great and I want to roll out more TPUs, it's just hard to support that because you can't get the material.
I am curious if you can kind of also just kind of talk about this idea of the CapEx spend numbers that we did already hear from basically all the companies that we care about, and what we can extrapolate into the longer term growth. And by longer term, I mean really over the next year or so for NVIDIA.
Yeah, no, I think you heard, I want to say Amazon CapEx looks to be up about 50%. Meta, I think is closer to 75%. And Google at the top end, I believe is closer to 100%. And they all said a greater proportion of that is going towards supporting data center servers and AI. And so, just roughly, if you're taking those three and calling it an average of 75%, I would expect their AI spend to grow at a rate that's north of that. And I would also expect that NVIDIA maintains share, again, in part because they've just done a better job setting up sourcing. So even if there's another technology out there, I think it's hard for them to get traction just because you're limited by how many wafer starts you can get, how much memory you can get.
I mean, Matt, there is so much to be buoyant about. We're expecting 68% growth in revenue, 72% growth in earnings per share, which is just extraordinary. And you do have an outperform rating, and you do think the stock is going to kick into a higher gear. What gets us there? Because we've been stagnant for months.
Yeah, so I would say for me, this feels very reminiscent to what we were running into last year. I mean, the concerns were slightly different, right? Last year, early 25, people were talking about the fact that we didn't have a new model from OpenAI. We had DeepSeek coming out. They came out with their model. Was it going to just destroy demand for GPUs? And are we actually going to see inference take off? Now we've seen new models, right? They're all really good. Inference use cases really seem to be taking off. The concern had been, can we see a pickup in spend? And we've had all the hyperscalers tell us that, yeah, we're going to spend more. So I think a lot of the questions have been answered at this point, and that we see something similar to what we saw last year, where all of a sudden people realize that NVIDIA is only trading at close to 20 times what real earnings in the out year are going to be, and that it typically peaks at 30. And so I wouldn't be surprised if that happens again.
Is there going to be a China story to tell tonight, Matt?
I don't know. We see so many different headlines in terms of China's taking H200s, China's not taking H200s. I think today it hit the tape that the State Department hasn't approved any H200 sales, even though NVIDIA is allowed to ship H200s. That's, to me, one of the key questions in the sense that unlocks some more revenue. But then that also gets into the supply chain problem again, in that I think that unexpected demand is going to be hard to meet, just because now you have to go get wafer starts, you have to go get memory. Certainly NVIDIA has some inventory they weren't able to ship previously, but shipping beyond that is probably going to be difficult.
You're going to stick with us, I'm pleased to say, Matt Bryson of Wedbush Securities, while we still are waiting in on these NVIDIA numbers to drop. But what we've got to weave in here is the idea that NVIDIA is not just a hardware story, but it's also an application and software story in many ways. Our next guest was one of OpenAI's first 100 employees. He left the company in May 2023, now with a new book, The Next Renaissance, AI and the Expansion of Human Potential. Joining us live is Zach Cass, former head of go-to-market at OpenAI, now a global AI advisor whose clients include Coca-Cola, Morgan Stanley, Amgen. Zach, it's great to have you with us. And what's so interesting is the intertwine between NVIDIA and OpenAI. In fact, so intertwined is it that Link's equities analysts have been talking about the worry they have that OpenAI perhaps isn't going to be spending the $500 billion Stargate initiative. Maybe it isn't going to be quite that capital expenditure. Maybe NVIDIA is not a commitment of $100 billion, but maybe a little bit less. We're actually just starting to see NVIDIA numbers coming through, Romain, at the moment. And first quarter revenue forecast does beat expectations, and their fourth quarter revenue was $68.1 billion. That is a big beat. It's above the 68% that we're anticipating, and their fourth quarter adjusted earnings per share coming in at $1.62.
Yeah, fourth quarter revenue, 73% growth rate at $68 billion. That is actually better than what the street was looking for. The EPS number at $1.62. You adjust that just a little bit, still above, well above what the street was looking for. Gross margin at 75.2%, right around what folks were expecting here. Data center revenue at 62.3, and then as Caroline was saying, the outlook here slightly above the consensus here. Revenue for the first quarter 76.4 to 79.56 billion. The low end of that range is about 3 to 4 billion above what the street was looking for, Caroline. And then we talk about this idea of sort of what more they need to articulate on that conference call, which is supposed to start in about 28 minutes.
We'll see what they say, but they're talking on this particular statement. Computing demand is growing exponentially, Romain. The agentic AI inflection point has arrived. Grace Blackwell with NVLink is the king of inference today, delivering an order of magnitude lower cost per token, and Vera Rubin will extend that leadership even further. As ever, Jensen Huang sounds pretty optimistic.
Customers racing to invest in AI compute. Matt Bryson, he's still with us, Managing Director of Equity Research at Wedbush Securities. I know you got to get on the call in just a little bit, Matt, but overall, it doesn't look like any real surprises, certainly not downside surprises, though slightly stronger revenue than what the street was looking for.
No, I mean that's exactly, and still waiting to see the CFO commentary to get a bit more outlook in terms of what exactly they see in the various segments. But yeah, really good revenue outlook and stable gross margins, and yeah, looks like everything's good.
Everything's good. It'll be interesting to see how much Jensen tries to once again fight off this illogical software being destroyed by AI agents, but he does note how their customers are racing to invest in AI compute and enterprise adoption of agents is skyrocketing. Zach, is there any risk that this is so bullish it's bearish on the rest of the market because AI adoption is so much there that software gets hit once again?
From a software perspective, I mean it's really hard to say. Software's had a tough road recently, and you know it's I think you heard from your prior guest. It's a concern that AI is cannibalizing some of the software opportunity. I'm a hardware guy, so I can tell you hardware looks great, and I'm pretty happy with that.
Yeah, it certainly does. And they're talking about their expanding partnership with AWS and new technology integrations, revealing the leading inference providers as well, including Base 10, Deep Infra Fireworks. That's how they're sort of looking to be adoption and trying to fight off that concern that they're not just about training of these models, they're about the inference power as well. And Matt Bryson of Wedbush Securities going to let him get back to his knitting when it comes to hardware. Yeah. But Romain, it's interesting some of these numbers.
Yeah, and I just want to, I mean, I'm going through this. I mean, these are impressive. Not only just being, the top and bottom lines, but I was looking at this. So you're talking about a company whose operating expenses are rising at a clip of about 45%, which is, if you were a normal company, you would probably get slammed for that. But of course, you have the gross margins expanding. Yep. Now it's 75+% here. And they've basically been on an upward trajectory for some time now, other than that one little hiccup they had one quarter here. So this is a company that is still, despite the fact being the world's largest, it is a growth company.
It is.
Full stop.
Yeah. And this is what these orders of scale don't apply to some of these tech companies. The fact that most of them are still posting in excess of 20% growth on a revenue and a bottom line margin from both Meta and Alphabet, but all the way over to NVIDIA. At what point do they even slow themselves down? At the moment, for not. Gaming is the only area of slight weakness, and they talk about 3.7%, up 47%. I mean, still 47% year-on-year growth, driven by strong Blackwell demand in the gaming revenue area, but it was down 13% from the previous quarter.
Oh, remember those Halcyon days when it was just a gaming company?
Yeah. Look how it set it up for success.
All right, let's continue the conversation, Caroline, here.
Yeah, let's get to Zach Cass. I'm sorry we left you. Let's get back to you, Zach, because you are, of course, previous head of go-to-market over at OpenAI. When you think about some of the inference in particular that they're starting to penetrate with NVIDIA, some of the applications, you heard Jensen Huang just being so optimistic there about the agentic AI adoption skyrocketing. Is that what you're seeing? Is that the advice you're giving to your companies that you're going to at the moment?
Well, you asked a good question a second ago, which is at what point are we so bullish we're bearish? And I think that the market certainly is excited and continues to be excited about what Jensen is saying and what NVIDIA is doing for good reason, which is that AI is, we're still in the beginning of realizing how much value we could create with unmetered intelligence. And then the consequence of that is the rest of the market has to figure out what happens if intelligence is a resource. What happens if intelligence is in fact like water or electricity or the internet, and it tracks towards being unmetered. And that's something that macroeconomists and you are going to have a pretty amazing time over the next 10, 20 years trying to figure out.
Citrini Research is trying to figure it out right now for 2 years' time. And it's interesting that as we see NVIDIA rally after its numbers, we're seeing plumbing new depths of CRM for Salesforce. We're now off by 4.5%, let's call it. We saw that Snowflake did turn lower. So again, this anxiety around the software space being beaten up by agentic AI. How are you seeing, considering the book that you've just written, are you of this dystopian mindset that in 2028 we'll have extraordinary amounts of unemployment and maybe you and I will be having more time to write poetry?
Well, one of those things is dystopian, the other is not, and so I don't want to flirt too much with a future where we don't work, because I actually do think humans will figure out how to toil. But I do beg the question in the book: why must we work to be happy? And is there something else if we can figure out how to feed, clothe, and house everyone? can we not actually find more time to recreate with friends and families, places of worship, outside dining room tables? Is that not maybe why we're here? But we'll come to that later because the viewers want to ask or want to know the answer to the question, what's going on in software? And I think there's a reminder to everyone that the Citrini research report is as good at being mimetic as it is at sort of providing any real evidence. There are all sorts of flaws with the paper itself, but I think what's important is that we are all trying to figure out what's coming. Derek Thompson wrote something really smart this morning. He said no one has any idea what's happening, and that's half the problem. These responses are these capitulations are so dramatic. But I will propose this, which is we kept asking if AI was a bubble, and maybe we were asking the wrong question. Maybe software was the bubble all along. And I remind all of us that 10 years ago, everyone said these software prices are way too inflated. How could these companies possibly trade at 30x multiple? Well, maybe finally it's correcting. Maybe the value of software is sort of being found out, especially the monolithic pieces of software.
This gets to the idea, though, too. I mean, some of the pushback that we saw coming out of that report, I mean, they were kind of counter reports to this idea. And some of this, by Anthropic itself when it had that web stream, and I don't know if they were just playing lip service to it, but the idea that a lot of these tools that they've been rolling out, at least in their view, can be complementary rather than just kind of the destructive force that the market seems to think that they might be.
Well, again, destructive we should define destructive, because destructive in this case is destructive to market cap of a certain segment of companies, but actually quite creative to or additive to an entire other market segment. I mean, I think the question is, if AI creates a bunch of value, does it have to borrow some of that value from other segments? Probably. But can it also distribute that value to a bunch of other markets? Definitely. And I think the reminder I have is if value comes out of S&P, it's going to go, or software in particular, it's going to go somewhere else. And then you have to start asking, where does it go? And my bet for the last 4 years has been bio and life sciences, all novel sciences for that matter, molecular particle material, construction, and anything building in the real world, hospitality, entertainment. Like, there's a bunch of knock-on positive consequences if we actually reduce the cost of creating software. And I do think it's important that Anthropic tell people that they are a partner in this game.
Yeah.
But the reality is they may not be. I mean, they may just be taking value straight out of another company's market cap.
Yeah, and they might be. And look, there's a lot of issues in terms of how much we trust what they say. But to your point, though, too, I mean, I know we always focus on the downside of AI, the gloom and doom, that'll all sort of take all our jobs away. But you mentioned a few of the industries, and just last week we did a whole big special on a lot of these trucking companies and logistic companies that have really benefited from AI and machine learning. And those companies will tell you they've been actually using that type of machine learning now for long before ChatGPT sort of came into the public consciousness here. So when we talk about that upside benefit, why don't you think we're hearing, I guess, a little bit more of a narrative around that, or at least a narrative that is cutting through the noise?
Well, when I started writing the book, I basically decided I was going to tell a story about technology on behalf of an industry that can often struggle to tell its own story. And I think so much of big tech has lost consumer trust. Some of this is social media. Some of this is addiction to the screen. Some of this is just a waning trust in institutions right now globally. But there's a bigger issue, which is I do think that there's a lack of narrative around all that can be created if you unmeter intelligence, if you create a world where brilliance is as simple as turning on a light switch. And of course, I'm not proposing that everyone is smart. The internet doesn't mean we do research. Literacy doesn't mean that everyone reads. It simply means that we are now exploring a world where agency gives you the opportunity to unlock a bunch of new things. My expectation is we're gonna see a bunch of really incredible things created, in particular around novel sciences. Our ability to know much more about the known universe is coming, but people have to see that in order to get there. And we're still there's this space in between where what they're watching is software get crushed, and we don't yet have cars full of autonomous vehicles, and we don't yet have a cure for cancer. And people are like, okay, well, what's the value to me then?
Yeah. All right. Zach, always a pleasure. Zach Cass, Global AI Advisor, former head of go-to-market at OpenAI. And I do want to pick up where Zach left off there because there are some real-world examples of how this is actually being applied and actually having a real impact on people's lives and, well, more importantly, their work. Jennifer Smith joins us right now. She's the co-founder and CEO of a company called Scribe. It's an AI platform that gives organizations insight in how to optimize and improve their workflow. Jennifer, great to have you here. I mean, we talk about, this idea that the AI is something in the future, and we kind of forget that a lot of it is already here. A lot of us are already using it in a lot of ways to enhance our productivity in a way that isn't replacing us yet. Talk a little bit about just kind of the sentiment now around some of these AI tools, and specifically in the context of you founding this company and the reasons why you founded Scribe.
Yeah, thanks so much for having me here. I appreciate you grounding this in what's happening today, because I think so much of the conversation and optimism, excitement around AI is what's to come in the future. And the reality of what we see on the ground in so many enterprises today is there are these incredibly powerful tools, and yet they're not able to find the huge productivity unlock and savings for the employees and for the companies that's being promised more broadly.
When we talk about why we haven't heard a little bit more of that narrative, I know a lot of this is going on in the background. A lot of companies have deployed this. A lot of individuals have taken up these types of tools on their own, whether it's for work or even just managing their households and things like that. What's the scale up for that? Is this something that is just still nascent and we just need more adoption? Where do we stand?
I think we're not even in the first inning. I think most of what we're seeing in an enterprise context in an organization probably still lives with that individual or that team base. It's experimentation. And, you see estimates that companies have spent millions and millions of dollars on AI, and 95% of that have been experiments where they haven't seen any real ROI out of it. And so I think we're just at the beginning where we have these incredibly powerful tools at our disposal, and people are seeing great personal examples in their personal life, but we have yet to figure out how to really unlock that at scale in an enterprise.
I go back to what Jensen Huang is saying in the here and now in his statement. Enterprise adoption of agents is skyrocketing. Jennifer, when I think about what you're doing and you're optimizing workflow, how is it that Scribe is built? Are you built upon some of the foundational models, or is the latest Anthropic plugin a risk to your business?
We build upon the best of what's available, and whether it's Anthropic or OpenAI or others who are coming out with better and better models, customers benefit from that. That's a great thing for the world, right? And as they improve and maybe they're more competitive with each other, everyone benefits. It's a rising tide that lifts all ships. I think what we're seeing is agent adoption is skyrocketing in enterprises. So many enterprises realize they have to figure out how to make agents work for them. Where the gap comes from is you have more and more powerful agents over time, but they don't know the context of your business. No enterprise has any existing documentation or repository that they can feed to an agent and say, hey, here's what we do. Here's how work happens here. Here's what we're trying to achieve. Take this information and now apply intelligence to go make work happen. And that's the part that we're focused on helping our customers fix.
What's interesting is the use of these models depends on inference. The training was where the glut and demand of GPUs from NVIDIA really came from. But Jensen's really trying to talk about how the leading inference providers, whether it be Base 10, Deep Infra, Fireworks AI, Together AI, are cutting AI costs by up to 10x, they say, with open source models of NVIDIA Blackwell. How much does Jensen need to talk about the inference market share he now has, not just the training market share? And how much is that something that you're exposed to in your business? How much are you having to think about compute yourself, or is that more for your customers?
We're a benefit of it, and our customers are a benefit of it. And so all of these investments that you're seeing on behalf of NVIDIA, OpenAI, others, kind of across the stack, enterprises and the applications that build upon them are all beneficiaries of it. And what we're really focused on is how do we take the benefits of all of these investments and improvements in the underlying models and bring that to bear in a way that drives enterprise ROI. And that's about making it specific to the context of that enterprise. If you think about all of the training that has been done on these models, it's generalized training. Now, how do I translate that to the specific of how Acme Corp works? There are specific things that Acme Corp does. It has workflows that are unique to it. It has IP and intelligence and understanding and know-how that is specific specific to that company that the best model in the world is not going to know. And so the challenge for the Acme Corps of the world is, how do you take the best of what you know how to do, of what your company is, and feed that specialized knowledge into agents so that they can really work for you in your specific context.
It's been great speaking with you, Jennifer Smith, who's bringing AI to the workflow right now, co-founder and CEO of Scribe. Let's return to NVIDIA's earnings. There's some more breaking news that's been filed in a 10-K, Remain. NVIDIA disclosing U.S. government licenses. They've been granted the license by the U.S. in February 2026, as we'd assumed, to ship small amounts of H200s to China. And for specific China-based customers, the point is, they haven't been selling them thus far. How much does China want them? But it is interesting that we see that license being granted.
Well, yeah, and I think it's interesting, too, because we always talk about it through the lens of whether the White House is going to allow Jensen Huang to sell these things, and we kind of forget that the other side of the equation is whether Xi Jinping actually cares anymore and whether he's moved on, and obviously whatever tit-for-tat is going on between the two world leaders. But this is a big market, right? And at some point, NVIDIA needs to be a part of it. And all the U.S. companies need to be a part of it. And the question is, how do they find a way there that satisfies some of the national security concerns or some of the political concerns?
And maybe it extends the overall very focused supply, or at least customer supply, they have at the moment. We got the details that hyperscalers were just about 50% of fourth quarter data center revenue beat. Let's talk about that and about how the hyperscalers are affording all of this compute right now, because we really think about the large amount of debt that big tech companies have been issuing, and to a large extent, very investment grade and very taken down. But John Lloyd, of Global Head of Multi-Sector Credit at Janus Henderson Investors, can really talk through what is that. We have seen record issuance from Alphabet, then from the other hyperscalers, and it has been demanded and then some by the market. But John, how long can this last if we're going to see a lot of this CapEx funded by the debt markets?
Yeah, I think it can go on for a while here. The debt markets have been very receptive to funding the AI build-out and data center build-outs across all the various markets in fixed income, whether that's starting with investment grade or even in the CMBS, ABS. The private markets have been involved, and the high-yield credit market.
So when we talk about this, just how much the market can absorb, I mean, there's one thing to say, okay, we have somewhat of an appetite for this type of debt, but there's also just the volume of it, of what potentially could come down the pipe. How prepared are they?
Yeah, I think it's been one of the more telegraphed supply technicals that's come into our market in a while. We've seen CapEx numbers for the hyperscalers go up this year. Our expectations is that supply could be $150 billion. Right. The good news is all these hyperscalers, except for Oracle, are rated very, very highly in the investment grade index. And there's going to be a lot of demand for that paper, and it's a growth area of the
Good afternoon. My name is Sarah, and I will be your conference operator today. At this time, I would like to welcome everyone to NVIDIA's fourth quarter earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. Thank you. Toshiya Hari, you may begin your conference.
Thank you. Good afternoon, everyone, and welcome to NVIDIA's conference call for the fourth quarter of fiscal 2026. With me today from NVIDIA are Jensen Huang, President and Chief Executive Officer, and Colette Kress, Executive Vice President and Chief Financial Officer. Our call is being webcast live on NVIDIA's Investor Relations website. The webcast will be available for replay until the conference call to discuss our financial results for the first quarter of fiscal 2027. The content of today's call is NVIDIA's property. It can't be reproduced or transcribed without our prior written consent. During this call, we may make forward-looking statements based on current expectations. These are subject to a number of significant risks and uncertainties, and our actual results may differ materially. For a discussion of factors that could affect our future financial results and business, please refer to the disclosure in today's earnings release, our most recent Forms 10-K and 10-Q, and the reports that we may file on Form 8-K with the Securities and Exchange Commission. All our statements are made as of today, February 25th, 2026, based on information currently available to us. Except as required by law, we assume no obligation to update any such statements. During which is posted on our website. With that, let me turn the call over to Colette.
Thanks, Toshiya. We delivered another outstanding quarter with record revenue, operating income, and free cash flow. Total revenue of $68 billion was up 73% year over year, accelerating from Q3. Growth on a sequential basis was also a record as we added $11 billion in data enabling vehicles that can think. The first passenger car featuring by data center. Consistent with last quarter, we are not assuming any data center compute revenue from China in our outlook. GAAP and non-GAAP gross margins are expected to be 74.9% and 75% respectively, plus or minus 50 basis points. For the full year, we continue to see gross margins in the mid-70s. We will keep you updated on our progress as we prepare for the Vera Rubin transition. GAAP and non-GAAP operating expenses are expected to be approximately $7.7 billion and $7.5 billion, respectively, including stock-based compensation expense of $1.9 billion. For the full year, we expect non-GAAP operating expenses to grow in the low 40s on a year-over-year basis as we continue to invest in our expanding opportunity set. For the full year, fiscal year 27, we expect GAAP and non-GAAP tax rates to be in between 7 and 19%, excluding any discrete items and material changes to our tax environment. With that, let me turn the call over to Jensen. I think he has a few words for us.
This quarter, we significantly deepened and expanded our partnerships with leading frontier model makers. We recently celebrated OpenAI's launch of GPT 5.3 Codex, trained with and inferencing on Grace Blackwell NVLink 72 systems. GPT 5.3 Codex can take on long-running tasks that involve research, tool use, and complex execution. 5.3 Codex is deployed broadly inside NVIDIA. Our engineers love it. We continue to work with OpenAI toward a partnership agreement and believe we are close. We are thrilled with our ongoing partnership with OpenAI, a once-in-a-generation company we've had the pleasure of partnering with since their first days. Meta Superintelligence Labs is scaling up at lightning speed. Last week, we announced that Meta is deploying millions of Blackwells and Rubin GPUs, NVIDIA CPUs, and Spectrum-X Ethernet for training and inference. This quarter, we announced a partnership with Anthropic and a $10 billion investment in their company. Anthropic will train and inference on Grace Blackwell and Vera Rubin systems. Anthropic's Claude Codework agent platform is revolutionary and has opened the floodgates for enterprise AI adoption. Between Claude Codework and OpenClaw, compute demand is skyrocketing, and ChatGPT moment of agentic AI has arrived. With partnerships spanning Anthropic, Meta, OpenAI, and xAI, NVIDIA deployed across every cloud, and with our ability to build full-stack AI infrastructure from the ground up or support them in the cloud. We're uniquely positioned to partner with frontier model builders at every stage: training, inference, and AI factory scale-out. Finally, we recently entered into a non-exclusive licensing agreement with Grok for its low-latency inference technology and welcomed a team of brilliant engineers to NVIDIA. As we did with Mellanox, we will extend NVIDIA's architecture with Grok's innovations to enable new levels of AI infrastructure performance and value. We look forward to sharing more at GTC next month. Okay, back to you.
We will now transition to Q&A. Operator, please poll for questions.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from Vivek Arya with Bank of America Securities. Your line is open.
Thanks for taking my question. I think you mentioned that you now have growth visibility into calendar 27 also, and I think your purchase commitments kind of reflect that confidence. But Jensen, I'm curious, when you look at your top cloud customers, cloud CapEx close to $700 billion this year, many investors are concerned that it would be harder for this level to grow into next year. And for several of them, their cash flow generation capability is also getting compressed. So I know you're very confident about your roadmap, right, and your purchase commitments and whatnot, but how confident are you about your customers' ability to continue to grow their CapEx? And if their CapEx doesn't grow, can NVIDIA still find a way to grow in that envelope? Thank you.
I am confident in their cash flow growing. And the reason for that is very simple. We have now seen the inflection of agentic AI. And the usefulness of agents across the world in enterprises everywhere. You're seeing incredible compute demand because of it. In this new world of AI, compute is revenues. Without compute, there's no way to generate tokens. Without tokens, there's no way to grow revenues. So in this new world of AI, compute equals revenues. And I'm certain that at this point, with the productive use of Codex and Claude Code and the excitement around Claude Cowork and just the incredible enthusiasm about OpenClaw and the enterprise versions of them. All of the enterprise ISVs who are now working on agentic systems on top of their tools platforms. I'm certain at this point that we are at the inflection point. We've reached the inflection point, and we're generating profitable tokens that are productive for customers and profitable for the cloud service providers. And so the simple logic of it, the simple way to think about it is computing has changed. What used to be software running on computers, modest amount of computers, call it $300 or $400 billion worth of CapEx each year, has now gone into AI. And AI, in order to generate tokens, you need compute capacity. And that translates directly to growth, and that translates directly to revenues.
Your next question comes from Joe Moore with Morgan Stanley. Your line is open.
Great, thank you, and congratulations on the numbers. You talked about some of the strategic investments that you've made into Anthropic and potentially OpenAI, CoreWeave as well, but also partners, Intel, Nokia, Synopsys. You're clearly at the center of everything. Can you talk about the role of those investments and kind of how do you view the balance sheet as a tool to kind of grow NVIDIA's position in the ecosystem and participate in that growth?
As you know, fundamentally at the core of everything NVIDIA is our ecosystem. That's what everybody loves about our business. The richness of our ecosystem. Just about every startup in the world is working on NVIDIA's platform. We're in every cloud. We're in every on-prem data center. We're all over the world's edge and robotic systems. Thousands of AI natives are built on top of NVIDIA. We want to take the great opportunity that we have as we're in the beginning of this new computing era, this new computing platform shift, to put everybody on NVIDIA. Everything is already built on CUDA, and so we're starting from a really terrific starting point. But as we build out the entire AI ecosystem, whether it's in AI for language or physical AI or AI physics or biology or robotics or manufacturing, we want all of these ecosystems to be built on top of NVIDIA. And this is such a wonderful opportunity for us to invest into the ecosystem across the entire stack. Our ecosystem is also richer today than it used to be. We used to be largely a computing platform on GPUs, but now we're a computing AI infrastructure company, and we have computing platforms on, well, every aspect of that. And everything from computing to AI models to networking to our DPU, all of that has computing stacks on top of it. And as I mentioned before, whether it's in enterprise or in manufacturing, industrial, or science or robotics, each one of these ecosystems have different stacks. And we want to make sure that we continue to invest into our ecosystem. So our investments are focused very squarely, strategically on expanding and deepening our ecosystem reach.
Your next question comes from Harlan Sur with JP Morgan. Your line is open.
Good afternoon. Thanks for taking my question. Networking continues to rise as a percentage of your overall data center profile, right? Through fiscal 26, your networking revenues accelerated on a year-over-year basis every single quarter, right? With 3.6x growth, as you guys mentioned, year-over-year growth in Q4. Obviously, on the strength of your scale-up and scale-out networking product portfolio, I seem to remember that first half of last year, your annualized run rate on your Spectrum-X Ethernet switching platform was around $10 billion annualized. It looks like that may have stepped up to around 11, 12 billion in the second half of last year. Jensen, looking at your order book, especially with Spectrum XGS, upcoming 102T Spectrum 6 switching platforms launching soon, where is the Spectrum run rate trending now and as you foresee exiting sort of this calendar year?
Yeah, as you know, we see ourselves as an AI infrastructure company, and the AI computing infrastructure includes CPUs, GPUs, and we invented NVLink to scale up the one computing node into a giant computing rack. We invented the idea of a rack scale computer. We don't ship nodes of computers, we ship racks of computers. And that NVLink switch scale up system is then scaled out using Spectrum X and InfiniBand. We support both. And then further, we also scale across data centers using Spectrum X scale across. And so the way we think about networking is really an extension. We offer everything openly so that people could decide to mix and match in different scale and however they would like to integrate it into their bespoke data center. But in the final analysis, it's all one big part of our platform. And the invention of NVLink really turbocharged our networking business. Every rack comes with 9 nodes of switches, and each one of them has 2 chips in it, and in the future they'll have more. And so the amount of switching that we do per rack is really quite incredible. We're also now the largest networking company in the world. And if you look at Ethernet, we came into the Ethernet market about a couple of years ago into Ethernet switching. And I think that we're probably the largest Ethernet networking company in the world today, and surely will be soon. And so Spectrum X Ethernet has been a home run for us. But we're open to however people want to do networking. Some people just really love the low latency and the scale-up capability of InfiniBand, and we will continue to support that, of course. And some people love to integrate their networking across their data center based on Ethernet. And we created an Ethernet capability that extends Ethernet with artificial intelligence way of processing in the data center, and we're incredibly good at that. And our Spectrum X performance really shows it. The difference of when you built a $10 billion or $20 billion AI factory, the difference of 10%, and it could be easily 20% on the effectiveness and the utilization of your network for your data center, that translates to real money. And so NVIDIA's networking business is really, really growing fast. And it's, I think it's just because we built the AI infrastructure so effectively, and the AI infrastructure business is growing incredibly fast.
Your next question comes from CJ Muse with Cantor Fitzgerald. Your line is open.
Yeah, good afternoon. Thank you for taking the question. I guess with CPX for large context windows and Grok likely adding a decode specific solution, curious how we should think about your future roadmap. Should we be thinking about customized silicon either by workload or customer as an increasing focus by NVIDIA, particularly helped by your move to a dialect architecture? Thanks so much.
Everybody should want to extend push out dialect as long as they can. And the reason for that is because every time you cross a dialect, you have a dialect, you have to cross an interface. Every time you cross an interface, you add latency, you add power unnecessarily. We're not allergic to dialect. We use dialects already, but we try to use dialects only when we absolutely have no choice but to do so. And so if you look at the Grace Blackwell architecture and the Rubin architecture, we use 2 giant reticle limited dies and we abut them. And that reduces the amount of architecture crossing. The dialect tax shows up in the architecture effectiveness of the competitors. If you look at NVIDIA, people call it our software advantage. But where software starts and architecture starts and ends is kind of hard to tell. It's, our software is effective because our architecture is so good. And so the CUDA architecture is unquestionably more effective, more efficient, delivers more performance per flop per watt than any computing architecture out there, and it's because of the way we architect. With respect to how we think about Grok and the low latency decoder, I've got some great ideas that I'd like to share with you at GTC. But the simple idea is that our infrastructure is incredibly versatile because of CUDA, and we're going to continue to do that. You know, all of our GPUs are architecturally compatible, which means that when I'm working on optimizing models today for Blackwell, all of that work and all that dedication to optimizing software stacks and new models also benefit Hopper and also benefit Ampere. It's the reason why A100 continues to feel fresh and continues to stay performant years after we've deployed it into the world. Architecture compatibility allows us to do that. It allows us to invest enormously in software engineering and optimization, knowing that our entire install base in the cloud, on-prem, everywhere, from generations of architectures of GPUs will all benefit. And so we'll continue to do that, and allows us to extend the useful life, allows us to have innovation, flexibility, and velocity, which translates to performance, and very importantly, performance per dollar and performance per watt for our customers. And so what we'll do with Grok is you'll come to see GTC, but what we'll do is we'll extend our architecture with Grok as an accelerator in very much the ways that we extended NVIDIA's architecture with Mellanox.
The next question comes from Stacy Rasgon with Bernstein Research. Your line is open.
Hi, guys. Thanks for taking my questions. Colette, I wanted to dig a little bit into the call for sequential growth through the year. So, I mean, you grew this quarter more than $10 billion sequentially in data center, and the guide seems to imply, you know, the bulk of the increase, $10 billion sequential in data center. So, like, how do you see that as we go through the year, especially as Rubin ramps into the back half? Blackwell's been a pretty massive acceleration for sequential growth. Should we expect something similar as we get to Rubin? And then I was also just hoping you could comment on your expectations for gaming. I understand the memory issues and everything else. Do you think gaming can still grow year over year in fiscal 27, or will that be under more pressure given memory? So those two questions, please. Thank you.
Thanks, Stacy. Let me start with the revenue going forward. Again, we're trying to look at revenue quarter by quarter. As you think about the full year, we are absolutely going to be still selling and providing Blackwell, probably at the same time that we're also seeing Vera Rubin come to market. This is a very great architecture that helps them just today, quickly standing up, and have already planned on many different orders across the different customers to provide that. It's too early yet to determine how much in terms of that Vera Rubin, that beginning ramp will start in the second half, and we'll get through it. But no confusion in terms of the strong demand and the interest. We do expect pretty much every single customer to be purchasing Vera Rubin. The question is, how soon are we in market, and how soon are they able to stand that up in terms of in their data centers? That was your first part. The second part was focusing on our gaming. As much as we would love to have additional more supply, we do believe for a couple quarters it is going to be very tight. If things improve by the end of the year, there is an opportunity to think about what that is from a year-over-year growth. But it's still too early for us to know at this time, and we'll get back to you as soon as we can.
Your next question comes from Atif Malik with Citi. Your line is open.
Thank you for taking my question. Jensen, I'm curious if you can touch on the importance of CUDA, as now more of the investment dollars in AI are coming from inference workloads.
Oh, without CUDA, we wouldn't know what to do with inference. The entire stack from TensorRT LLM that we introduced a few years ago, which is still the most performant inference stack in the world, optimizing it for NVLink, requires us to discover and invent new parallelization algorithms that sits on top of CUDA to distribute the workload and the inferencing to take advantage of the aggregate bandwidth across NVLink 72. NVLink 72 has enabled us to deliver generationally 50 times more performance per watt. It's just an incredible leap, and it's sensible. NVLink 72 is a great invention. It was hard to do. The creation of the switching technology, disaggregating the switches, building the system racks, all of that, we did it all in plain sight, and everybody knew how hard it was for us to do. And but the results are incredible. So performance per watt is 50 times, performance per dollar 35 times, and so the leap in inference is incredible. It's very important. It's really important to realize that inference equals revenues now for our customers, because agents are generating so many tokens, and the results are so effective. When the agents are coding, it's off generating thousands, tens of thousands, hundreds of thousands, because they're running for, minutes to hours. And so these systems, these agentic systems, are spawning off different agents working as a team. The number of tokens that are being generated is really, really gone exponential. And so we need to inference at a much higher speed. And when you're inferencing at a much higher speed, and each one of those tokens are dollarized, it directly translates into revenues. And so inference performance equals revenues for our customers. For the data centers, inference tokens per watt translates directly to the revenues of the CSPs. And the reason for that is because everybody is power limited. And so, no matter how many data centers you have, each data center, 100 megawatts or 1 gigawatt has power limits. So the architecture that has the best performance per watt translates, because each token, the performance tokens per watt, each token is dollarized. Tokens per watt translates to dollars per watt, which translates in a gigawatt directly to revenues. And so you could see that every CSP understands this now. Every hyperscaler understands this, that CapEx translates to compute. Compute with the right architecture translates to maximizing revenues, and compute equals revenues. Without investing capacity today, without investing in compute, there cannot be revenue growth. And that I think everybody understands. Compute equals.
Your next question comes from Atif Malik with Citi. Your line is open.
Thank you for taking my question. Jensen, I'm curious if you can touch on the importance of CUDA, as now more of the investment dollars in AI are coming from inference workloads.
Oh, without CUDA, we wouldn't know what to do with inference. The entire stack from TensorRT LLM that we introduced a few years ago, which is still the most performant inference stack in the world, optimizing it for NVLink requires us to discover and invent new parallelization algorithms that sits on top of CUDA to distribute the workload and the inferencing to take advantage of the aggregate bandwidth across NVLink 72. NVLink 72 has enabled us to deliver generationally 50 times more performance per watt. It's just an incredible leap, and it's sensible. NVLink 72 is a great invention. It was hard to do. The creation of the switching technology, disaggregating the switches, building the system racks, all of that, we did it all in plain sight, and everybody knew how hard it was for us to do. And but the results are incredible. So performance per watt is 50 times, performance per dollar 35 times, and so the leap in inference is incredible. It's very important. It's really important to realize that inference equals revenues now for our customers, because agents are generating so many tokens and the results are so effective, when the agents are coding, it's off generating thousands, tens of thousands, hundreds of thousands, because they're running for, minutes to hours. And so these systems, these agentic systems, are spawning off different agents working as a team. The number of tokens that are being generated has really, really gone exponential. And so we need to inference at a much higher speed. And when you're inferencing at a much higher speed, and each one of those tokens are dollarized, it directly translates into revenues. And so inference performance equals revenues for our customers. For the data centers, inference tokens per watt translates directly to the revenues of the CSPs. And the reason for that is because everybody is power limited. And so, no matter how many data centers you have, each data center, 100 megawatts or 1 gigawatt has power limits. So the architecture that has the best performance per watt translates, because each token, the performance tokens per watt, each token is dollarized. Tokens per watt translates to dollars per watt, which translates in a gigawatt directly to revenues. And so you could see that every CSP understands this now. Every hyperscaler understands this, that CapEx translates to compute. Compute with the right architecture translates to maximizing revenues, and compute equals revenues. Without investing capacity today, without investing in compute, there cannot be revenue growth. And that I think everybody understands. Compute equals revenues. Choosing the right architecture is incredibly important. It's more than strategic now. It directly affects their earnings. And choosing the right architecture, the one with the best performance per watt, is literally everything.
Your next question comes from Ben Reitzes with Melius Research. Your line is open.
Yeah, hey, thanks. First, let me say kudos on including the stock comp in non-GAAP. I think that's a great move, but that isn't my question. My question's around gross margins and the sustainability of the mid-70s long term. Should we read into the visibility on supply being available into calendar 27 that it's sustainable until then? And then, Jensen, what about after that? Are there innovations in memory consumption you can unveil that makes us feel better about the ability to keep margins at that level for a long time? Thanks.
The single most important lever of our gross margins is actually delivering generational leaps to our customers. That is the single most important thing. If we could deliver generationally performance per watt that exceeds dramatically what Moore's Law can do, if we can deliver performance per dollar dramatically more than the cost of our systems, than the price of our systems, then we can continue to sustain our gross margins. That's the simple, most important concept. The reason why we're moving so fast is because, number one, the demand for tokens in the world as a result of the inflection points that we've gone through has gone completely exponential. I think we're all seeing that, to the point where even our 6-year-old GPUs in the cloud are completely consumed and the pricing is going up. And so we know that the amount of computation necessary, the amount of compute necessary for the modern way of doing software is growing exponentially. And so our strategy is to deliver an entire AI infrastructure every single year. This year, we introduced 6 new chips. Rubin next generation will do many new chips as well. And every single generation, we are committed to deliver many X factors of performance per watt and performance per dollar. And that pace and our ability to do extreme co-design allows us to deliver that value and that benefit to the customers. And that is the single most vital thing as it relates to our value delivered.
Your next question comes from Antoine Chikaiban with New Street Research. Your line is open.
Hi, thanks a lot for taking my question. I'd like to ask about space data centers, which some of your customers are considering. How feasible do you think that is, and on what kind of horizon? And what do the economics look like today, and how do you think that could evolve over time? Thank you.
Well, the economics are poor today, but it's going to improve over time. As you know, the way that space works is radically different than how it works down here. There's an abundance of energy, but solar panels are large, but there's plenty of space in space. The heat dissipation, it's cold in space. However, there's no airflow, and so the only way to dissipate heat is through conduction. And the radiators that you need to create are fairly large. Liquid cooling is obviously out of the question because it's heavy and freezes, and so the methods that we use here on Earth are a little different than the way we would do it in space. But there are many different computing problems that really wants to be done in space, and so NVIDIA is already the world's first GPU in space. Hopper is in space, and one of the best use cases of GPUs in space is imaging, to be able to image at extremely high resolutions using of course optics and artificial intelligence, and to be able to do that computation of reprojection of different angles, and be able to up-res and do noise reduction, and just be able to image at very high resolutions, extremely large scales, and very, very fast. It's hard to do that by sending petabytes and petabytes of imaging data back here on Earth and doing that work. It's easier just to do it out in space, and then ignore all of the data collected and processed until you see something interesting. And so artificial intelligence in space will have very good, very interesting applications.
Your next question comes from Mark Lipacis with Evercore ISI. Your line is open.
Hi, thanks for taking my question. I want to pick up with the comment you made on the script about revenue diversification. I believe, Colette, you said that hyperscalers were over 50% of revenues, but growth was led by the rest of your data center customers. And as a clarification, I just want to make sure I understood that. Does that imply your non-hyperscale customers grew faster? And if so, can you help us understand what are the non-hyperscalers doing different? Are they doing different things than the hyperscalers, or the same things on a different scale? And do you expect this trend to continue? Would you expect your customer base to evolve to a point where non-hyperscalers become a bigger part of the larger part of your business? Thank you.
Yes, let's see if we can help on this question. So when you think about our top five, as we articulated as being our CSPs, our hyperscalers, and they have right now sat at about 50% of our total revenue. There's a big organization, therefore, of diversity of all different other types of companies that we are working with. That it goes through our AI model makers, that goes through our enterprises, that goes to supercomputing, it goes to our sovereigns. There's a lot of other different facts on there, but you are correct. It's a very fast-growing area as well. We have a strong position in terms of all of our different cloud providers on our platform, and now we also have an extreme diversity of different customers that we are seeing all the way across the world. And this will really benefit seeing that diversity and being able to serve all of those parts. I'm going to see if Jensen wants to add a bit more.
Yeah, this is one of the advantages that we have with our ecosystem, all built on top of CUDA. We're the only accelerated computing platform that is in every cloud, that's available through every single computer maker, available at the edge, and we're now cultivating telecommunications. Obviously, the future radios will all be AI-driven radios, and the future wireless network will also be a computing platform. That is a foregone conclusion, but somebody has to go and invent the technologies to make that possible. And we created a platform called Ariel to go do that. We're out in just about every single robot, every single self-driving car. Our ability, CUDA's ability, to have the benefit of the performance of specialized processors on the one hand, with the tensor cores inside our GPUs. On the other hand, the flexibility of CUDA allows us to solve language problems, computer vision problems, robotics problems, to biology problems, physics problems, and just about all kinds of AI and all kinds of computation algorithms. And so the diversity of our customer base is one of the greatest strengths that we have. The second thing, of course, is without our own ecosystem, even if our processor was programmable, if we didn't cultivate our ecosystem, and talking about some of the things that we're doing today, investing in our future ecosystem and continue to enhance our ecosystem. Without our ecosystem, it's hard for us to grow beyond what design wins we capture for somebody else's ecosystem. And so we could grow and expand our ecosystem very naturally because of our the platform that we created. And then lastly, one of the things that's really important is the partnerships that we have with OpenAI and Anthropic, with xAI, with Meta, now makes, and of course, just about every single open source in the world. There's 1.5 million AI models on Hugging Face. All of it runs on NVIDIA CUDA. And so an open source in totality probably represents the largest, it's the second largest model in the world. OpenAI is the largest. Second largest is probably all the collection of all the open sources. And so NVIDIA's ability to run all of that makes our platform super fungible, super easy to use, and really safe to invest into. And so that creates the diversity of customers and the diversity of the platforms and available in every single country, and because we support the whole world's ecosystem.
Your next question comes from Aaron Rakers with Wells Fargo. Your line is open.
Yeah, thanks for taking the question. I guess, sticking with the idea of the platform and extreme co-design, some of the news over this last quarter has obviously been NVIDIA's ability or push to bring Vera CPUs to market on a standalone solution basis. So I guess, Jensen, I'm curious of what's the importance that Vera plays in this architecture evolution as we move forward? Is this being driven more by the proliferation or the heterogeneity of inference workloads? I'm just curious of how you see that evolving for NVIDIA, particularly on a standalone CPU basis. Thank you.
Yeah, thanks. And I'll tell you some more about it at GTC. But at the highest level, we made fundamentally different architecture decisions about our CPUs compared to the rest of the world's CPUs. It's the only data center CPU that supports LPDDR5. It is designed to be focused on very high data processing capabilities. And the reason for that is because most of the computing problems that we're interested in are data-driven, artificial intelligence being one. And the single-threaded performance in this ratio with bandwidth is just off the charts. And we made those architectural decisions because in the entire phase, the different phases of AI, from data processing, before you even do training, you have to do data processing. So you have data processing, pre-training, and in post-training now, the AIs are learning how to use tools. And the usage of tools, many of those tools run in CPU-only environments, or they run in CPU with GPU-accelerated environments. And Vera was designed to be an excellent CPU for post-training. And so some of the use cases in the entire pipeline of artificial intelligence includes using a lot of CPUs. we love CPUs as well as GPUs. And when you accelerate the algorithms to the limit as we have, Amdahl's law would suggest that you need really, really fast single-threaded CPUs. And that's the reason why we built Grace to be extraordinarily great at single-threaded performance, and Vera is off the charts better than that.
Your next question comes from Tim Arcuri with UBS. Your line is open.
Thanks a lot. Colette, I was wondering if you can talk about the deployment of capital. I know that you really jacked up the purchase commits, but it sounds like maybe you're over the hump on this, and you're going to probably generate about $100 billion in cash this year. So, and pretty much no matter how good the results have been, the stock hasn't really gone up much. So I would think that you probably feel like this is a pretty good price to be buying back a bunch of it here. So I was wondering if you can talk about that, like. Question being, why not put a big stake in the ground and just, have a huge share repo here? Thanks.
So thanks for the question. We look at our capital return very, very carefully, and we do believe that one of the most important things that we can do is really supporting the extreme ecosystem that's in front of us, that stems from everywhere, from our suppliers and the work that we need to do to assure that we can have the supply that's needed and help them from a capacity, all the way that we are in terms of the early developers of the AI solutions that will be on our platform. So we will continue to make this a very important part of our process and strategic investments. But of course, we are still repurchasing our stock. We are still with our dividend as well. And we will continue to find the right unique opportunities within the year for doing those different purchases.
Your final question comes from Jim Schneider with Goldman Sachs. Your line is open.
Thank you for taking my question. Jensen, you've previously outlined the potential to get to 3 to 4 trillion of data center capex by 2030, which implies a potential acceleration in growth rates, which you've sort of guided to at least this next quarter. The question is, what are some of the key application areas that you believe are most likely to drive that inflection? Is that physical AI, agentic, or something else? And do you still feel good about that $3 to $4 trillion envelope? Thank you.
Yeah, let's back that up and just reason through it from a few different ways. So the first way is on first principles, the way that software is done in the future using AI is token driven. And I think everybody talks about tokenomics and talks about data centers generating tokens, and inference is about generating tokens. And we generate tokens. We were just talking about tokens, how NVIDIA's NVLink 72